Okay, so before we start, a brief introduction about myself. My name is Malav Soni. I'm from India. I'm an Indian chartered accountant, plus I'm an ACC as well. My core area of say working is IFRS and Indian accounting standards. So I do take care of trainings on IFRS. Plus I do consulting as well for the IFRS and Indian accounting standard advisory. Olgario, are you there? Videos on, please, guys. Please keep the videos on. Please, videos on. So if you guys can introduce yourself in brief, so what exactly you are doing, your qualification background, so
Yes,
I
I'm
can
here.
plan accordingly. Yes, yes, please. SCDO, am I pronouncing it right? One by one, Olgario, SCDO, please. Brief introduction about yourself, guys, with the videos on. Yes, please. Your network is not stable, I guess.
Oh, but I can understand you very well.
I think your network was breaking. If you can, yeah, okay, start. I know now. I think I can hear you. Yeah.
Okay. Good morning, everyone. Yeah, it's a morning in Mozambique. So my name is Asisen Mwan. I'm a chartered accountant here, Mozambique.
Okay.
I hold
Okay.
a bachelor degree in accounting and auditing. So I have over 12 years experience working in accounting.
Okay. That's great.
So
That's
I have some
great.
certification. I have some international certification. I've done CPA, certified professional accountant, and I've already done CCA,
Okay.
certified
That's great.
corporate accountant.
That's great. That means
So
my
this
work
is
is
another
easy.
one.
My work will be easy. You are too much qualified, so I don't have to work too much harder. Yeah, it's for easy for me to make you guys understand. Yes, Olgario.
I,
Yes. Olgario, am I audible? Olgario, can you hear me?
I think that is facing some issue of connection.
Maybe.
Yes.
Olgario, if you can just log out and rejoin again, I guess then it can help to resolve the network issue. If you can try that. Yeah, just wait for 1 minute. Let him fix his issues. Okay, now let me start. Olga, you check your network issues and then we'll have a talk with you.
Okay.
Fine. So to start with, first of all, uh, basic from let's start from the basic first, that is conceptual framework of financial reporting. Conceptual framework, when I'm talking about, say, they're basic, say, policies, conventions, rules for the accounting, basic rules. When we talk about accounting standards, so they are specific rules based on, say, different transactions. But this is, we can say, a base for the accounting standards. We can say this is Bible for the accounting, that is conceptual framework. Framework is again all the standards which are developed into standard different say accounting treatment which has been provided. Everything is coming from the framework itself. So we can say framework provides the general rules, basic rules that has to be followed. So first of all, who is using this framework? Why this is needed? So conceptual framework of financial reporting is used by International Accounting Standard Board when developing a new accounting standard, that is IS or IFRS, or revising the existing standard. So this is, as I said, this is a base rules, basic rules. Like say, for example, say if I talk about say elements of the financial statement. So we record only five things: income, expense, asset, liability, and equity. But then if we look at our statement of financial position, which is a balance sheet, so we may have different types of asset. We bifurcate the assets into different categories like tangible asset, non-tangible asset, current asset, non-current asset, financial asset, non-financial asset, etc. So when I'm talking about framework, framework talks about asset. Okay, what is an asset? And what should be an asset accounting? But based on that, specific standard regarding say tangible asset, intangible asset, current inventory receivables, different standards are developed by following this basic rules. So this is used by the Accounting Standard Board IASB when developing or revising an IFRS or IS standard. Second, it is used by preparers of the financial statement when no relevant IFRS or IS standard exists. So when I'm talking about IFRS, it includes both IAS, which stands for International Accounting Standards, and IFRS stands for International Financial Reporting Standard. So before the year 2010, the standards which were issued, they were in the name of International Accounting Standard IAS. From 2010, there are some changes into the structure of the board. And later on, say after 2010, the board started issuing standards in the name of IFRS, that is International Financial Reporting Standards. So second point is saying that when there is no relevant IFRS, so if we talk about say cryptocurrencies, digital tokens, till today there is no specific accounting standard available for accounting of cryptocurrency. So when any such transaction arises, how to account for the same? Okay, so as a preparers, we can refer the conceptual framework of financial report. So that is the use of the framework. What is a framework? So it is theoretical principles and concepts that underline the preparation and presentation of financial statement. Preparation and presentation. So basic theory rules, basic concepts based on which financial statement has to be prepared and presented. Why framework is important? Because if no framework existed, then accounting standard would be produced on a haphazard basis as particular issue and circumstances arose. So if there is no basic guidance, then in that case, anyone can develop standard like anything, whatever thing. Everyone has a different, say, thinking. Everyone has a different, say, perception. Everyone has a different viewpoint. So need basis, different, but no, we cannot do that. There is a framework available, and that is the basic minimum thing that we have to follow. So background of the framework is initially the framework was issued in 1989. Then in 2004, International Accounting Standard Board, which is there in UK, and Financial Accounting Standard Board from USA. They started a joint project. Objective is to revise their respective accounting frameworks. So as a result of this particular project, the board means International Accounting Standard Board, they issued conceptual framework for financial reporting in 2010. So first framework was there in 1989. Then the revised framework was issued in 2010. Okay, what are the changes into 2010 framework? So say most of the text from the 1989 framework was simply rolled over, but two chapters were revised. And these are very important chapters. Number one, objective of financial reporting. And second one is the qualitative characteristics of the useful financial information. So what is the objective? Why we have to report? Why we have to prepare financials? What is the objective? That is updated in the framework of 2010. And when I'm talking about financial statements, okay, I am recording information into that. So what qualities should be there into that information? That is also updated in 2010 framework. So after this issue of the framework in 2010, International Accounting Standard Board and Financial Accounting Standard Board, they suspended work on this particular project. But after 2010 framework also, some criticism arised. So again, if say industry, users, professionals, they think, okay, there's still something missing into this. So there's still, we need some more guidance, still need revision. So what are the criticism or the areas where further guidance was required? So it says that it did not cover certain areas like derecognition, presentation, and disclosure. So recognition means to record or to include something into financial statement. Derecognition means to remove something. So say still on derecognition of few transactions, like say maybe on some assets or liabilities, further guidance is required. Presentation. So presentation may be like we do, like say whether it will be the item will be part of my statement of profit loss or statement of financial position, whether separate presentation is required or separate presentation not required, whether current non-current bifurcation is required. So that is presentation part. So that area is not too much covered into the framework of 2010, and some additional areas of say disclosure requirements also. Second criticism was guidance into some areas are unclear, like with regards to measurement uncertainty. Now, very important part is if we talk about say prudence concept. Prudence concept says that a transaction we say we basically record transactions on a monetary items. Monetary terms, we record transaction in money value. Now, when this valuation is not certain, it is difficult to measure. Let's say, for example, if we talk about some say an online shopping website like say Amazon. So Amazon basically what they are doing, they provide say a return policy to the customers for 15 to 20 days, that okay, if customer is not satisfied with the product, customer can return the product and Amazon will refund the money. So this is basically a transaction called sale with return basis. That means if you are not comfortable, you can return it. But again, when I'm saying that if you are not happy with the product, I will return your money. That means I'm under obligation. So if I'm a seller and I'm saying that, say, if you're not satisfied with the product, I will give your money say back and you can return the product. That means I am under obligation. That means I need to create provision in my financial statements. Now, how can I create provision? Provision is a what? It is an estimated amount. Now, if that estimation, just an example of measurement uncertainty, what I'm giving. So say if I am not sure, say if I'm selling 100 products, out of 100 products, how many customers can come back and ask for a refund? I'm not sure. Maybe 10 customers can ask for a refund, or maybe 70 customers can ask for a refund. So on how much, say, units I should create provision, measurement is uncertain. Now, why it is uncertain? Because the information which we have to provide, we provide information about future cash flow of the company. So users are interested to know what is going to be the future cash flow of the company. So in that case, say if I estimate that, okay, out of 100, 10 customers can return the product and ask for a refund, and I create provision based on 10 units, but actually 70 customers are asking for a refund, or vice versa. I created provision based on 70 units and only 10 customers, so that the provision is very uncertain. I'm not sure on how much unit provision is to be created. So any of such situation arising while preparing the financial statement where the measurement uncertainty is there, so how to deal with? Okay, so that guidance is also unclear. That was the criticism for 2010 framework. They said some aspects were out of date, like recognition criteria for assets and liabilities. So because of this criticism, International Accounting Standard Board considered this project in priority, and they started working on the project again on 2012. Now, when they started working on this project on 2012, this time, Financial Accounting Standard Board from USA was not there. ISAB started on its own. So as a process, in 2013, they issued discussion paper. So discussion paper is basically, this is a process that is to be followed when any new accounting standard is to be issued. So first of all, whatever the areas, the criticism arised, ISAB issues a discussion paper. Okay, so you can see this is my thinking. This is we think that, okay, how this issues can be resolved. This discussion paper is issued to the professionals of different accounting bodies, and then they provide their comments on the same. So with that, we gather the different viewpoints of different professional bodies, professionals, industry, etc. Based on that, exposure draft is being prepared. So on the response received on the discussion paper, a draft was issued with the amendments in 2015. Now on that draft also, feedback is taken from the industry professionals, from the various professional accounting bodies from the world. And based on that feedback, final framework was issued in 2018. So currently the conceptual framework of financial reporting which we are using right now is framework published in 2018. As we discussed, what is the purpose of the framework? So the purpose of the framework is to assist the board. Board means International Accounting Standard Board, when developing new IFRS standard, to assist preparers of the financial statements when no IFRS standard applies to particular transaction. Like as we discussed, as of now, there is no accounting standard for cryptocurrencies or digital tokens, and to assist all other parties when understanding or interpreting the IFRS standards. So if I want to understand, I want to interpret, first of all, I need to understand the framework of the financial report. Very important is framework is not accounting standard. It does not override the requirement of particular IFRS standard. So as I said, framework talks about asset only. And based on the basic accounting treatment of asset, specific standards are developed for, say, property, plant and equipment, investment property, inventory, receivables, etc. So these are specific rules. So specific rules will always prevail over the framework. So we always have to provide priority to the IFRS standard first when we have a specific IFRS available. Framework is not a standard. Now the main thing which is revised in 2010 framework, objective of the financial reporting. So the conceptual framework states that the purpose of financial reporting is to provide information to the users of the financial statement that will enable them to make decisions about providing economic resources to the entity. So frame objective is what? I need to provide information to the users. Users means all the stakeholders. Bankers, shareholders, government, tax department, customers, suppliers, employees, all of this are considered as my stakeholders. They are considered as my users of financial statement. So say if I talk about a banker, say I need a loan of $10 million, so I go to a bank. Okay, bank will say that okay, no, bank has to take a decision that okay, whether 10 million funding can be provided to my organization or not. So for that they need my financial information. Okay, so therefore, okay, that why they will ask for a financial statement. So why we are preparing? Objective is to provide information to the users so that they can make their economic decisions accordingly. Another important point is when the users want to make decisions, they need information. What they want to assess? Okay, users are interested to make assessment about entities' potential future cash flow. So say as a banker, if say I am providing a loan of $10 million to an entity, so I would be interested what will be company's future cash flow so that okay, I can get my loan repaid in time along with interest. So I'm interested to know about future cash flow. And second one, management stewardship of the entity's economic resources. That means efficiency of the management, that how well resources of the organization are used by the management, which will generate future cash flow. So always users are interested about assessment of this two things, future cash flow and management efficiency. Now, when I'm talking about future cash flow, so future cash flow includes two things. Number one, timing of the cash flow. So when cash will come or when cash will out. And second one is the amount of cash. So future cash flow includes both timing and amount. So to provide, say, information about the cash flow, or maybe say to understand what is going to be the future cash flow, user need information about the economic resource of the entity, that is assets. Okay, why information about assets is required? Because asset will generate to create cash inflow. Asset can generate cash flow in two different ways. Number one, I can sell the asset, I can generate cash flow. Second one, asset can be used into business, and that by use of that asset, future cash flow will be generated. So number one information is, okay, to understand about the cash flow, I need information about assets. Second one is economic claims against entity. So here I'm talking about cash outflow. What are the organization's obligations? What are the company's liability, where cash will go out? So they are talking about liability and equity. And changes into this economic resources and claim. So changes into assets and liability, that is called income and expense. So basically, we need to provide information so that future cash flow information is available. So framework, what is the content of the framework? So first of all, it provides definition, recognition and derecognition criteria, measurement criteria of the elements of financial statements. There are 5 elements of the financial statement. Number one, asset; second, liability; third, equity; income and expense. These are 5 elements. So what is income, what is expense, what is asset, what is liability, what is equity? Definition is provided into conceptual framework. Then recognition criteria. So when to recognize, what are the conditions? Shall we recognize or not? For that, framework provides basic recognition criteria. Derecognition criteria, that means removing something from the financial statement. So when asset can be removed from the financial statement, when liability can be removed from the financial statement. Basic is given into the framework part. Measurement criteria. So we know that, okay, we have to record the transactions in money terms. So how to measure asset, how to measure liability, how to measure income, expense? Measurement rules are also provided into the framework. So before say accounting standard or a framework, they basically talks about 4 things. So whenever any business transaction happens, always first question arises. Now, at the time of business transaction, first question is, can I record this transaction in my financial statement or not? So for that, we have to refer recognition criteria given into framework and recognition criteria given into specific accounting standard. Okay, if those criteria are satisfied, the next question will come. Okay, I can recognize, but now the second question is, what is the value? At what value transaction should be recorded? So for that, measurement criteria are there. Okay, measurement is also decided. Then the third question will come about presentation. So how to present this? In which statement they will be presented? Statement of profit loss, statement of financial position. Into statement also, whether separate presentation required, not required, that is presentation part. And final part is disclosure requirements. Disclosure means additional information. So information which are required so that the transaction can be understood in a more appropriate manner by the user. So that disclosure. So any accounting standard always, be it IFRS or be it a national accounting standard of any country, accounting standards provides information about 4 things: recognition, measurement, presentation, and disclosure. So that is the first content of this, is provide definition about the definition, recognition, measurement, and derecognition about the elements. Then, as I said, 2010, first is objective of the financial reporting was revised. Second thing which was revised was the qualitative characteristics of the information. So the information what we are providing through financial statement, what qualities should be there into that financial statement, that is number one. It provides guidance on presentation and disclosure requirements of the financial statement, like aggregation. So aggregation means clubbing together similar items. So when this aggregation can be done, when it cannot be done. So like say into my balance sheet, we total all the receivable balances, and into balance sheet we put only one line item, trade receivables. So over there, this all are customers, similar nature of items. Okay, aggregation is allowed. But I cannot club all the current asset into one, like inventory, receivable, say cash balance, bank balance. I cannot club everything into one because I don't know which is current. So where aggregation is allowed, where aggregation is not allowed, guidance is provided into framework. Classification. So classification, current, non-current classification. So basically the liability which is going to be settled within next 12 months classified as current. Liabilities which is going to be settled for more than 12 months, non-current. Same goes with the asset also. Asset that is going to be realized in 12 months from the reporting date, it is current asset. So these details are also provided in the framework. And it talks about other comprehensive income. Other comprehensive income, I'm parking aside right now. We'll discuss after few slides. So now let's, important point is the characteristics of the useful information. So this is divided into two parts: fundamental characteristics and enhancing characteristics. Fundamental characteristics are two. Number one is relevance. So what do we mean by relevant? So relevant means any information which can influence the decision of the user, then it is relevant information. So while preparing financial statements, management has to decide that whether this particular information can influence the decision making of the user or not. So for that, we have to check materiality, how material transaction is. Talking about revenue. Okay, revenue, of course, very important information, because on that, user will get to know that, okay, how much sale company is doing over a period of years. What is the profit margin? Okay, relevant information. Asset accounting, depreciation. Okay, what is the useful life of the asset? Till what time asset can be used? Relevant information. So management has to decide, okay, the information, whether it is going to affect the decision making of the users, yes, then it is relevant. Second one is faithful representation. Now, faithful representation of the transactions which is recorded in the financial statement. Here, important point is framework says that we need to focus on economic substance of the transaction rather than legal form. That means, say, we do not have to say only legal form, we have to say substance. Best example of this is lease accounting. So into lease accounting, say as a lessee, as a tenant, when I take an asset on a lease, that means I am not the legal owner of the asset. But still, I record the same as asset into my financial statement. Economic substance, because the tenure for which a lease transaction is made, say for example, I have taken an asset for a lease of 5 years. So for this 5 years period, I have control over this particular asset, how to use it. I am going to get economic benefits out of the same. That means I have control over this resource. So even though I am not the owner, still I need to record it as it. That is faithful representation. So faithful representation, another important thing we need, that transaction has to be complete. Neutral means without any bias. And third one is error free. So these are fundamental characteristics, very important. Then we have enhancing characteristics. So comparability. So framework says that whatever information you provide, you should provide on a comparative basis. So therefore, the financial statements, when we prepare, we provide current year's information, and in that comparison, we provide previous year information also. That is comparability, so that user can understand in which direction the business is going. Timeliness. So framework says that, okay, you should provide information well in time. Late information is of no use. Verifiability. So whatever information we are presenting into the financial statement should have been verified with some documents, like, say, for example, if I'm putting bank balance into my balance sheet. So the bank balance on my reporting date, I can cross verify with my bank statement. Understandability. So information you should provide in such a manner that can be easily understood by the users. So not too much of aggregation, not too much of detailed information which is not required. So provide in such a way that it can be easily understood by the users. And fifth one is cost constraint. So cost constraint, when I'm talking about, say, when I have to provide some information, it is going to say incur some cost. So framework says that you look at the transaction and see that what benefits user is going to get out of this, and what is your cost to provide this information. So if your cost is higher compared to the benefit which user is going to get, in that case, it is okay to take exemption, avoid that information. So cost benefit analysis, what they are talking about. So this is my qualitative characteristics of the useful information. Any questions so far? Anything, any question, any doubt?
So by myself, I think that there is clear. So I would like to know if you will have this presentation. We'll get it in email after the lesson.
Yeah, you will get the material. Yeah, don't worry.
Yeah, so I have one question about framework and because sometime I heard that say that the framework is not the standard. Framework is not the standard.
Framework is not a standard, right?
So I would like to know, in case of conflict between framework and the standard, what remain?
Standard first.
Standard. Okay.
Standard is always in priority, because this is basic guidance and they are specific transactions. Like, say, we'll see that this talks about asset. Then we have separate standard for property, plant and equipment, investment property, inventory. So they are very specific. So always they are rules. So always standard first preference. When standard is not available, then only framework is to be considered.
Okay, thank you. Thank you.
Olgario, any question from your end? Olgario, any questions? You there? If any issues with your mic, you can just drop a message into chat box also, maybe network. Yes, your mic is on. Go ahead.
Yes, for a while it's all okay. I was
Okay.
just to understand more about the faithful representation.
Faithful means, say, basically I need to provide honest and correct presentation about my business transactions. So number one is transaction has to be complete. Complete means, okay, you need to provide everything. Like, say, when I'm talking about asset, so into balance sheet, my asset carrying value is there. Into my statement of profit loss, depreciation of the same is there. But how this depreciation is provided, So we, as a part of disclosures, we provide, okay, what is the depreciation method we followed? What is the useful life of the asset? What is the residual value? So with regards to this, all the details has to be there. That means it has to be complete. Neutral means there should not be any bias. That means, say, if management is, say, planning to raise some funds in future. So when I want to say borrow money from a bank or maybe from the investors, I would like to be, say, make my balance sheet stronger. So in that case, maybe I would like to overvalue sometimes my asset or undervalue liabilities. So that should not be there. Whatever is the value as on reporting date, you should report the accurate values only. That means it should be neutral and error free. That means no mathematical or no conceptual error. And into faithful, important part is economic substance. So when I'm talking, let's say if I take an example of asset only, if I say I'm not the owner of the asset, I'm not the legal owner of the asset. So that does not mean I should not record this transaction into financial statement. So we'll see when IFRS 16 lease accounting. So say I have taken a property on lease from another entity for a period of 5 years. Now for this 5 years, I have all the control over this property, how to use this property. From the use of property, whatever benefits are generated, that all belongs to me. So that means technically I have rights over this property for a period of 5 years. That means, okay, that is your resource which you are controlling and which is generating economic benefits for you. So this should be your asset. So therefore they are saying, don't look at the legal form, look at the substance of the transaction, and accordingly your financials should be prepared. Am I making sense now?
Yes, thank you.
Then financial statements. So the purpose of financial statement is to provide information to the users about entities, assets, liabilities, equity, income, and expenses. So this information is provided into statement of financial position, or we call it balance sheet also. IFRS allows both the terms. Statement of financial position and balance sheet, both the terms are there. But into your textbook, majorly the term statement of financial position is used, but they are not saying balance sheet cannot be used. Yeah, both the terms are fine. So into statement of financial position, we provide information about assets, liabilities, and equity. Statement of financial performance. So where we provide information about income and expenses of the business. And other statement like statement of cash flow. So into statement of cash flow, we present the cash movement during the year, from where cash has came into business, from where cash has gone out. Notes to accounts. So notes to accounts are basically two types of notes are there. Accounting policy notes and say policy notes and say explanatory notes. Now, can anyone help me with this? What is accounting policy note and what is explanatory notes? Yes, guys.
Oh, what
Policy
is it?
difference between accounting policy notes and explanatory notes.
Accounting policy notes and I didn't get well.
Explanatory notes. Explanatory notes.
Yeah,
Yeah.
I feel that this both I don't understand well about this one. I explain it policy account.
Explanatory notes are, say, we prepared the notes to accounts, like we prepare this schedule for the non-current asset with the schedules what we prepare. inventory schedule, the schedules for the receivables. These are explanatory notes. An accounting policy note means the policy what we have followed. So for inventory, we write that, okay, inventory is valued at cost or NRV, whichever is lower. Lease is recorded as right to use it in. So that is policy notes. So basically this, if you say take any of the annual report of the listed company, so you will see that the schedules which we prepare for our statement of profit loss and balance sheet, they are called explanatory notes, which provides explanation about the individual amount recorded into, say, profit loss or balance sheet. So into my balance sheet, there is only one amount, trade receivables. But for that, we provide explanation as, okay, what is the aging report? So how many receivables are not due? How many are due for more than 90 days, more than 120 days? Or so likewise that we provide breakup of the same aging report, that is explanatory note. An inventory valuation, okay, inventory is valued at cost or net realizable value, whichever is lower, that is policy note. So financial statements are prepared on going concern assumption. So we always believe that this entity is going to continue for, and for there is no closure happening. Again, now see why this going concern assumption is important. And it says that when going concern assumption is not accurate, then financial statement should be prepared on different basis. As we discussed before, users are interested to know about future cash flow of the entity. Now, when I'm talking about future cash flow, I'm talking about amount of the cash flow and timing of the cash flow. So into my statement of financial position, into my balance sheet, we classify asset as non-current and current asset. We do same for the liabilities also, current and non-current liabilities. So non-current liabilities means these liabilities are payable after 12 months from the reporting date. Current liabilities that we are going to settle within next 12 months. So we take estimate, okay, cash flow. This is the time when this much amount will be payable by company, this much amount will be received by company. But if company is not going concern, then there is nothing like no non-current liability. Going concern is not there. That means it will be liquidated very soon. So therefore saying that, okay, I need information about timing. So going concern, that means, okay, this business is not going to close. That means if I have an asset with a useful life of 10 years, so then my assumption is that this asset will be used by business for 10 years. And over a period of 10 years, this asset will generate cash flow for the company. So I'm assuming, okay, this asset will be used into business. But if it is not a going concern, they are filing for liquidation. That means this asset will be sold and cash will be realized immediately. So that is why this going concern is important. Why? Because future cash flow information is critical for users. Next slide talks about the elements of the financial statement. So definition is provided. Number one, economic resource, which is called asset. Now definition is very important. So what is the definition? Present economic resource controlled by entity as a result of past event. Again, I am repeating, it is a economic resource controlled by entity. So there are two important terms here. Number one, economic resource. Economic resource means right which has potential to produce economic benefits. So same lease transaction what we discussed. So when I take asset on a lease from another entity for a period of 5 years, that means I have all the rights to control this asset, how this asset is going to be used. Okay, when I use this asset, that will generate cash flow for me. So economic resource means a right which has potential to generate economic benefits. Now, economic benefits can be in the form of revenue, also in the form of savings of cost, also anything can be there. So economic resource controlled by the entities. That so even though entity is not the legal owner, still if any of the item is falling into the definition of asset, entity has to recognize asset into balance sheet. And that is why in case of leased asset, we create asset into statement of financial position. Second one is economic claim, which is called liability first and equity second one. So liability means present obligation of the entity to transfer economic resource as a result of past event. Present obligation because of past event. Very key rules are there. There has to be a past event. That means, say, for example, I purchased some goods on credit. So purchase of goods is a past event. Now, because of that, I am under obligation to pay my supplier. Okay, it is a liability. So past event is very important in when I'm talking about a liability. Equity. Equity means residual interest in the net asset of the entity. So residual interest means my total assets minus liabilities. So at the time of, say, closing of the business, from the assets of the company, all the liabilities will be repaid, and the remaining value, which is called residual interest, will be given to the owners of the company, that is equity. Then changes into economic resource and claims as a result of performance. So when I'm talking about performance, we talk about income and expense. So definition of income is increase of asset or decrease of liability, which results into increase of equity. So say this is my accounting equation. Let's say assets minus liabilities is equal to equity. This is my accounting equation. So say my assets are 100, liability is 70. So my equity is going to be 30 in that case. Okay, what is the definition of income? So say increase of asset. Okay, let's say my asset is increasing from 100 to 120. No change into liability. So what will happen? Because of this, my equity will increase. Increase of asset, which resulting into increase of equity. Okay, so that, okay, your assets are more, so owners will have more profit into that. It is your income. Assets are not changing, but liability is reducing by 70 to 50. That will also result into increase of equity 30 to 50. So this is called income. If I talk about expense, expense means decrease of asset. Okay, so my asset is going down from say 100 to 80. Liability is remaining constant. Equity is reducing from 30 to 10. Asset remaining constant, increase of liability, that will also result of equity. So this is my, by the accounting equation, we can understand what is the definition of income and expense. And lastly, other changes into economic resources and claim like, say, why, what are the other changes? So contribution from and distribution to equity shareholders. So when new shares are issued, entity will generate funds. So that is again, resources are coming to the company when they pay dividend to the equity shareholders, that result into, say, decrease of resources. So this is all my about elements of the financial statement. Very important is, see, definition and this basic rules are very important. The more understanding we are having about this, it will be very easy for us to interpret any difficult accounting situation. So be very careful and be very, say, confident about the basics. Fundamentals are very important as always. All right, can we have a break for 5 minutes and then we can continue? Yes, guys, 5 minutes break.
Yes, yes, sounds good.
Okay, so will resume in 5 minutes.
Okay.
Yeah. So after the definitions, now talking about the recognition. So framework says that whenever a business transaction is happening, the first question will arise, okay, can I record this transaction in the financial statement or not? Okay, so for that, they provided guidance on the recognition. It says that items are recognized in the financial statements if they meet the definition of one of the element. So that means whenever a transaction is happening, I need to see, okay, what is the item involved into it? Let's say, for example, I am purchasing, say, a printer for my office. So into this transaction, items involved are printer and other one is my bank balance. I'm paying by say, I'm doing online payment. So I need to ask a question whether these items are meeting the definition of one of the element. That means whether it is, say, asset, liability, equity, income or expense. If it is one of the same, yes, we can move forward. But then also one more condition, say elements are recognized if recognition provides user with the useful financial information. So item which is involved into my transaction is either asset or a liability, income or an expense, or it is an equity. Yes, so by that rule we can account it. But we have to see one more thing, that if we record this element, whether it is going to provide useful information or not. If it is not going to provide useful information, no need to record it. Example of the same is contingent liabilities. Contingent liability means obligation of the company, but where the chances of settlement are less than 50%. Possible obligation. So basically in accounting terms, there are two terms which are used. One is possible, second one is probable. Probable means more than 50% chances that this settlement will happen. Company has to make payment. And when I'm talking about possible, that less than 50% chances that company will settle. So in that case, say contingent liabilities, we do not record into financial statements. Again, reason, framework. Why framework? Again, the logic is we need to provide information. Information has to be relevant. And when I'm talking about information, users are interested to know about future cash flow of the company. So cash flow which is not going to happen, or say cash flow for, say, outflow chances are very less. So there are only 20% chance that company has to make settlement. So in that case, if the same transaction is recorded as a liability, then user will have an impression that, okay, company might have to pay this, which actually is not going to happen. So the cash outflow, which is, say, chances are very less. If we record it as a liability, then the information will not be useful for the users. And therefore it is saying that elements are recognized, but only if they are resulting into useful information for the company. Second important point is we have to see the measurement uncertainty as well. So if there is high degree of measurement uncertainty, the same example I would repeat, say about the Amazon. So Amazon provides, say, return option to the customers. Almost on all the products, 15-20 days return option is there. So definition of liability is what? Present obligation because of past event. So when I apply this definition, say when Amazon is making sale, the past event has already happened. With sale, it is saying that, okay, if you are not happy with the product, you can return the product and I will refund the money. So because of past event, because I sell my product on sale with return right, I am under obligation. So I am under obligation. That means, okay, I need to create some kind of provision for the same, that, okay, I have to make an estimate how much refund I may have to process. But if that how much refund I have to process, or maybe out of, say, 100 units, how many customers can come back and ask for a refund? If that cannot be measured reliably, then transaction should not be recorded. Again, reason same, future cash flow. So future cash flow, again, as I said, users, when I'm talking about future cash flow, I'm talking about two things: timing of the cash flow and amount of the cash flow. So let's say, for example, there is measurement uncertainty. I am selling 100 product and I am estimating that, okay, at least 10 customer only will ask for a refund. Okay, so based on that, I am creating provision for 10 units. Okay, when user will see the balance sheet, they will understand like this, okay, 10 customers can return. So maybe for 10 customers, company has to pay refund. So they take care of the cash flow accordingly. But actually, 80 customers came for the refund request. So actual cash flow is going to be much higher what is recorded. Similar situation, say I created provision for 80 units. That's saying that, okay, so I'm creating a bigger amount of provision, but actually only 10 customers came for a refund. So that is called uncertainty. And when uncertainty is there, again, the amount what we are recording, that is not useful for the users, because you are not sure about the actual cash flow, what is going to happen. So in that case also, do not recognize in the financial statement. So in any case, if, say, any of the asset or liability is not recognized, disclosures may be required. So we have to make disclosures. So in case of contingent liability also, we make disclosure that, okay, there is a, say, court case going on against the company, details about the same. If decision will not come in the favor of the company, then what could be the possible financial effect? So these kind of disclosures are there when an element is not recognized in the financial statement. Right? So talking about recognition again, first we have to see whether it is one of the element or not. Second one, whether this is going to provide useful information or not. If it is going to provide useful information, then only record. Not relevant information like contingent liabilities. So less chances of having an outflow and measurement uncertainty. These are the two things where we can say the information will not be useful. Then talking about the derecognition. So derecognition means removal of some or all of the assets or liability from the statement of financial position. So recognition means to include in the financial statement. Derecognition means to remove from the financial statement. So when derecognition happens for the asset, so definition of asset is what? Resource controlled by the entity. So when entity loses control, so when there is no control, that means there is no asset. Okay, remove the asset from the financial statement. When it can happen? So if I sell the asset, so I transfer the control to the buyer. Or if say asset, I have used the asset for the complete useful life. So the useful life of the asset is over. That means, okay, there is no control, no asset. No, I no longer can use this asset. Liability. So definition of liability is present obligation because of past event. So if obligation is fulfilled, then there is no obligation left. Say, for example, say I purchase goods on credit, I make payment to my supplier. Okay, so after that, after the payment, I do not have obligation. So we remove liability. That means we remove creditors from the financial state. So how accounting is done for the derecognition? So we have to remove it. We have derecognizing asset or liability. So basically on the date of derecognition, we compare the carrying value and the settlement amount, and differential amount is going to be my gain or loss. Any question into this recognition? Why we are recording? Concepts are very important. So any doubt into this? Yes, any question onto this? Is this okay?
I have no question. I have no question.
Okay, thank you. Now, after recognition, so this it's like a chain. Step by step, accounting happens. So first, when we recognize, the question will come: what is the value with which we can recognize? So for that, measurement criteria are given. So when we recognize the elements into financial statements, they must be quantified in monetary terms. So framework provides two bases of measurement. Number one, historical cost. Second one, current value. So either you can record assets or liabilities at historical cost. Historical cost means the cost at initial recognition. So let's say, for example, I am purchasing a car today. Okay, so what is my purchase price today? That is called historical cost. Then I will not change value of the car. Okay, depreciation is what is historical cost. Then over a period of wear and tear, but we will not record any revaluation. Like if market value increases for the car, maybe it is a vintage car. Say if I am buying a property. So property has a characteristics of capital appreciation. The value of property increases normally. But I'm saying historical cost, okay, I have a building, I purchased a building or I constructed building today, then I will provide depreciation, but I will not record any movement for the market value changes. So that is called historical cost. That is what we do normally, historical cost accounting. So transaction is recorded with the value at the time of initial recognition. And after that, movement into the same, like if I talk about assets, so depreciation is a movement. If we talk about liability, interest is the movement, payment is the movement. That is how we account historical cost accounting. Second base they provided is current value. Current value includes three different terms. Number one, fair value. Second one, value in use. And third one is current cost. So fair value means, just we discussed, like say I have a property, land and building. Now land and building is an asset which has a potential of capital appreciation, which value can increase. So if I am following current value basis, that means I have to remeasure the property at fair value. So let's say if I have a property which I purchased for 5 million 1 year back, today value of same property is, for example, 6 million. So I will revalue my property from 5 million to 6 million. That is called fair value accounting or current value accounting. Second term is value in use. Value in use means present value of future cash flow. So say if I use the asset into business, it will generate future cash flow for me. Okay, how much cash flow it is going to generate? So based on that, current value accounting is to be done. So let's say, for example, I have a machinery with a useful life of 10 years. So based on that purchase price, we have recorded. But say after say a couple of years, there is an accident with the machinery and machinery got damaged. So when the machinery got damaged, of course, its production capacity can be affected. So which can result into less amount of production. So less amount of future cash flow. So in that case, we have to check for value in use, that is present value of future cash flow. So we provide impairment for the same. So basically, when I have to find out recoverable amount of the asset, how much maximum we can recover out of this. So value in use is the one where it is used. And third current value concept is current cost. So current cost is basically also considered as replacement cost. But this current cost accounting is normally done where into an economy where inflation level is very high. There only this current cost measurement is applied for. Otherwise, current cost is very rare scenario where the current cost is being used. How it works? Let's say, for example, I have purchased, say, a printer for 10,000 for my office 2 years ago. Useful life, I assume that I can use this printer for 10 years. So today, current carrying value of the same after providing 2 years depreciation, the carrying value of the printer is 8,000. But say the economy where my business is operating, inflation is too high. So today, if I am going to buy same type of printer, yes, same, exact same, no additional features, zero difference, identical printer, but today value of the same is 15,000. This is the level of inflation. No change, no advanced version, nothing. Same printer, but 2 years ago, I was able to purchase it for 10,000. But now the same printer has a value of 15,000. So of course, when this new printer has effect of inflation, like say same, it was 2 years ago, it was available for 10,000. Now it is available for 15,000. So because of that, my current value of 2 years old printer can also increase because it will also have impact of the inflation. So how much can be my replacement cost or a current cost for the same? So for that, okay, we have to see it is available for 15,000. Okay, my printer was purchased 2 years ago. Okay, if 2 years ago, okay, what could be the depreciation for 2 years? 10 years is the life. So here annual depreciation is going to be 1,500. 2 years depreciation is 3,000. So current value is 12,000 because of the inflation. So we have 2 years old printer in my financial statement with the value of 8,000, but current value, or we can say replacement value of the same because of the inflation effect, is 12,000. So when this kind of say economical situation is there, so financial statements are adjusted on reporting date to record this inflation impact. That is called current value measurement basis. So framework is providing this two bases, historical cost and current value. But which approach to follow, historical cost or a current value? So to decide that, framework says that we have to assess that which measurement base is going to provide more relevant information to the users. So if I do historical cost, is it going to be more relevant, or if I do current value, then it is going to be more relevant? Okay, so how to decide which is more relevant? So for that, framework says that, okay, you have to see the characteristics of asset or liability and the way in which asset or liability going to contribute into future cash flow. So let's say, for example, we purchased a car for our office. So characteristics of the asset. Okay, car is an asset where normally value depreciate. The moment we get the car out of the showroom, value immediately goes down. Okay, so characteristic of the asset is what? The value is always going to depreciate. There are no chances of increase in the value. How it is going to generate cash flow? So by use of asset. So when if I do historical cost accounting, okay, into historical cost accounting, today is my purchase value. That is my historical cost. Then we estimate about the useful life, and accordingly we are providing depreciation. Upward revaluation is not possible. Okay, so in that case, okay, historical cost, whatever what we need what? Okay, purchase price minus depreciation. This is the value of asset what I'm looking for. So that is already that can be received by following historical cost. Okay, so historical cost can be more appropriate basis for accounting such kind of assets. Now say instead of car, let's say if I'm talking about plot of land. Now land is something, the value can fluctuate, value can increase. Properties are always of capital, say appreciating nature. So in that case, if we follow historical cost do not talk about any upward revaluation. Historical cost means your original initial recognition and then movement into the same. No revaluation will happen. Okay, so in that case, if I do current value, then it will be more appropriate, more relevant for the users. So whether to apply historical cost or whether to apply current value to decide that this thing. So okay, which type of say, or when we can say which measurement will be more relevant, or it will provide more relevant information. Okay, how to decide? Okay, so to decide which will be more relevant for the user, we have to check for characteristics of the asset liability and the way in which going to generate future cash flow. After measurement, we talk about the presentation. So board always believes that entity specific information is more useful than standard descriptions. And duplication should be avoided because it makes the financial information less understandable. So to talk about this, say entity specific information. So if I talk about, say, simply about the inventory. Now inventory rule is what? Cost or NRV, whichever is lower. This is the valuation rule. Now this is common for all the entities. But how entity has determined its cost? Should decide the cost, what method is used? Okay, if any inventory is write down to NRV, okay, provide information about the same, that okay, what is the reason that net realizable value is lower than my cost? So why I'm writing off my inventory? That is entity specific information. So they're focusing always entity specific information, and the say duplication should be avoided. Classification. So classification into current, non-current liabilities. Again, why we have to do this? User want to know about the future cash flow. Future cash flow, timing and amount of the cash flow. So timing. So when I classify the asset or liability as current and non-current. So whatever liabilities are recorded at current, okay, user will get to know that, okay, this outflow will happen within next 12 months. Non-current. So user will get to know that, okay, yes, this outflow will happen after 12 months. So therefore classification is done accordingly. Offsetting classifies dissimilar items together and therefore generally not appropriate. So offsetting means, say, with the same entity, I have to say two transactions, purchase and sale both. So the same entity is my customer also and supplier also. So it is my payable and receivable both. So can I offset them and record only the net amount? Standard says no. There are two different transactions. Offsetting is not allowed. It is not appropriate. Yeah, whenever it is allowed, standard will provide you guidance on the same. But normally, offsetting is not allowed for. Then aggregation as a part of presentation only, that aggregation means adding together the items which have shared characteristics. Like my receivable balance, payable balance, I may have hundreds of suppliers, say thousands of customers. So I cannot put every customer name into my balance sheet. So for that, they said, okay, you can do aggregation. Just put receivables, one line item. But too much aggregation also should not be there. So otherwise, balance sheet will be of three line items only: assets, liabilities, and equity. This much of aggregation is not allowed. So after this, I said, okay, what is current asset? What is non-current asset? What is financial asset? What is in financial? What is tangible? Okay, that if I put only assets by aggregating all the assets into one, then it will obscure the information. So that is not allowed. And the final part into the statement conceptual framework is the statement of profit or loss and other comprehensive income. Now, as I said, say financial statements are prepared to provide information to the users. We provide information to the users about, say, assets and liabilities of the company. So that is called statement of financial position. We provide information about income and expense of the company. That is called statement of financial performance. And when I'm talking about statement of financial performance, performance means I'm more interested to know about the performance from the operating activities of the organization. So how business operations are there? That is the more say useful information for the user. So that means primary source of information. If I want to understand how company is performing, so primary source of information is statement of profit or loss. So that means into statement of profit or loss, only those transactions should be recorded which are, say, related to performance of the company, operations of the company. But there are some transactions which are not because of the, say, performance of the company. Like, say, if I'd say talk about property only, we talk that, okay, we are doing revaluation. I'm using current value approach. So say I have a plot of land with a value $50 million, market value of the same is $60 million. So if I increase the value of my property from 50 to 60 million, okay, my asset is increasing. That means it is my income, but it is just a market value change. I'm just remeasuring this at current value into my financial statement. But I'm not realizing this gain right now. I'm not selling this asset, just that market value is higher. So I am putting my asset at current value, increasing the value of the asset, but it is just a measurement. So if I include this 10 million gain into statement of profit or loss, my profit will increase by 10 million. It will shoot like anything. But again, number one, it is not realized. It is unrealized profit. There is nothing realized into cash. And another reason this is not from the operations of the company. This has because of the market value of it. It has nothing to do with trading or manufacturing activities of the organization. So if we record such transactions of remeasurement, so asset is one of the example. There are other areas also where these kind of remeasurement happens that we will see when we look at to the specific accounting standards. So if we record these kind of remeasurement transactions into statement of profit or loss, then the relevance of the profit or loss will reduce. Because why? When it is relevant, when it is providing you information about the performance of the company. And when something is included which is not related to performance of the company, your information relevance will get reduced. And that is the reason a separate statement called statement of other comprehensive income is prepared. And into statement of other comprehensive income, such transactions are recorded. So basically there is one single statement called statement of profit or loss and other comprehensive income. So into statement of profit loss, first of all the transactions relating to operations of the company, all the realized transactions are recorded into profit loss. And then below that, statement of other comprehensive income is prepared where these kind of remeasurement transactions are recorded. So this is why the other comprehensive income is important. Just that the information, relevance of the information, where to provide, where it is more relevant, accordingly we account for the same. So this is about the conceptual framework of financial reporting. We are done with the framework part. Any question, any doubt on the framework side?
Yes, just a doubt.
Yeah.
In measurement of elements, it's possible to apply both of them, the historical cost and the current value in in the elements of the financial statements.
Possible.
We talk about the
Yeah, possible.
vehicles and the land.
Yeah, again, yes. So
Oh,
see, we discussed that we have to see, wait, where it is? Yeah, this one. To decide which is more relevant, so we have to see the characteristics of asset. So vehicles and machinery, historical cost is more relevant. Land and building, current value is possible. We can apply different for different asset liability. That is fine. Perfectly okay. We can do that.
okay.
So we'll
And
discuss on the specific standards also. Property, plant and equipment is our next topic in which we will see that. Yes.
Okay, thank you. And do we need to write in the explained notes of the financial statements, or it's
Yes, of
not
course.
relevant?
We have to provide all
Oh,
the
thank you.
disclosures. Yes, yes. Disclosures are very important. So this all are called
Okay.
accounting policy notes. So it is part of your notes to accounts. Yeah.
Thank you, sir. I think that the doubt of Olgar was useful for me too. I have
Okay.
no, I think that it's clear.
All right. Okay. So after the framework, now moving on to specific accounting standards. So our agenda will be like that. First, we will discuss about all the accounting standards relating to assets. So we'll see first asset side of the balance sheet. Into that first accounting standard is IS 16 property, plant and equipment. So as I said, accounting standards provide guidance on four things: recognition, measurement, presentation, and disclosure. So whenever a transaction is happening, okay, first of all, we have to see whether it is one of the element or not. Okay, let's say, for example, we purchased a printer. So printer is falling into the definition of asset, that is present, say economic resource controlled by entity. Fine. So it is one of the, say it is the say asset for me, but which type of asset? We have different classification for the asset. So once it is decided that yes, it is an asset, then we'll see definition of different assets, different types of asset. Like we have property, plant and equipment, we have investment properties, we have say intangible assets like goodwill, trademark, etc. We have say category wise financial, non-financial assets. So we'll see definition into different accounting standards which are relating to asset, and then we will decide which accounting standard we need to apply for accounting of particular transaction. So first of all, say property, plant and equipment. Definition of the property, plant and equipment is tangible asset. Tangible means asset which I can touch, which I can see. So tangible assets held for the use in production of goods. So why I am holding an asset? I want to use this asset for production of goods. Example, my plant and machinery. Or supply of services. So let's say, for example, say my coaching institute, my classroom. Okay, why I'm using this? So that I'm using this to provide services to the students. Okay, supply of services. For rental to others. So let's say I have an extra car which I am giving to somebody to run into Uber. So for rental to others or for administrative purposes. Say my office where I'm sitting and working, my warehouse where I'm storing my goods. So these are my admin purpose, and which is expected to be used during more than one accounting period. So it is called property, plant and equipment. So say I purchased a printer. Okay, printer, why I'm using this? I am using this for my admin purpose. So I provide services to my clients. Okay, I need to get photocopy. I need to get some printouts. So that is for my back office work. Okay, so printer I'm purchasing, coming into the definition admin purpose. And I say I can use it for minimum period of 5 years. So it is going to be used for more than one period. So it is fitting into the definition of property, plant and equipment. That means for accounting of the same, I will apply IS 16. Okay, what is the scope of this particular standard? So IS 16 should be followed when accounting for property, plant and equipment, unless IFRS standards require a different treatment. So basically, majority of these tangible assets which are falling into the definition of property, plant and equipment, we have to apply this. But few exceptions are there where IS 16 is not applicable. Number one, biological assets. So biological asset relating to agriculture activity. Biological asset means living animal and living plant. Why it is not applicable? Because for that we have a separate accounting standard, IS 41, which talks about how to account for biological asset. But into biological asset also, this is important, there are bearer plants. So again, I am repeating, biological asset means any living animal or any living plant. So talking about bearer plant, now it is a plant. But bearer plant says that bearer plant is that which is used in the production or supply of agriculture produce. So it is a plant from which I can get agriculture products. But it is expected to bear the produce. That means it will give me agriculture product for more than one period. So same plant I can use to get agriculture product for more than one period. And it has a remote likelihood of being sold as a agriculture produce except for the scrap. That means this is a plant which itself is not a final product. It can used only to get agriculture product. For example, grapevines. So grapevine is a plant which is used to get grapes. Now this can be used for more than one period. So if we see the details of the bearer plant, it is coming into the definition of property, plant and equipment. Grapevine we are using so to get the production of grapes. We can get the grapes for more than one period. Okay, so that means useful life is more than one period. And grapevine is not a final product. I cannot sell grapevine as an agriculture product. It has had a scrap value only. That means bearer plants are falling into the definition of property, plant and equipment. So normally the bearer plants are say the biological assets like living animals and living plants are covered by IS 41, but only the bearer plant we have to apply IS 16 property, plant and equipment for the accounting purpose. Then second exception is mineral rights or mineral reserves like oil, gas, other non-regenerative resources. So over there also the standard is not applicable because for that we have a specific standard available, IFRS 6. Then property, plant and equipment classified as held for sale. So over there the standard is not applicable. IFRS 5 is the standard. So into this what will happen, let's say for example I have a building which I am using as my office. So this time it is falling into property, plant and equipment. So I'm applying IS 16 for the accounting. But now I'm deciding, okay, I want to move into new office and I want to sell my old office. So I decided to sell my old office. So then IFRS 5 will become applicable. So once I decide I want to sell my office, of course, there are some conditions for the held for sale classification. But when I decide that, okay, I want to sell this office, I'll move on to new office. So then IFRS 5 will come into picture. So then IS 16 will not be applicable. Right. So talking about the definition, first of all, tangible asset used in the production of goods or supply of services, or for rental to others, or for the admin purpose, and which is going say expected to be used for more than one period, that is called my property, plant and equipment. So as we discussed, a sequence is moves like that. First, a transaction happens. So okay, we look for the one of the element. Okay, it is there. Now then we look for the specific accounting standard. So we saw definition. Okay, so that it is property, plant and equipment. Now the question will come, can we record this particular asset as a property, plant and equipment into books of account? Can I recognize this? So for that, IS 16 provides recognition criteria. As I said, standard provides guidance on four things: recognition, measurement, presentation, and disclosure. So first, whenever a transaction, can I recognize this? So for all the assets, any type of asset, there are two minimum recognition criteria which must be satisfied. Okay, in some cases, some additional criteria may be there, but this two which are mentioned here, they are the minimum requirement. Then only we can recognize it. Number one, say item of property, plant and equipment should be recognized as an asset when it is probable that future economic benefits associated with the asset will flow to the entity. So number one requirement is future economic benefits. From where this is coming from? If we see, if you just recollect the definition of asset, economic resource controlled by entity. Economic resource means which has potential to generate economic benefit for the company. So that means economic benefit is a basic requirement, future economic benefits. And second one, reliable measurement of cost. Cost must be measured reliably. Now, when both of these conditions are, say, satisfied, then only item can, property, plant and equipment can be recognized. So whenever we are, say, recognizing any asset for the first time, that is called initial recognition. And after that, so once, say, asset is initially recognized, after that, any expense what we do on that particular asset, they are called subsequent expense. So these criteria apply at the time of subsequent expenditure also. Initially and subsequent, this recognition criteria are to be applied for, that is future economic benefits and reliable measurement of cost. So what do we mean by future economic benefits? So future economic benefits include both revenue generation as well as savings of cost. Both are considered as economic benefits. But when we talk about the future economic benefits, so we have to say assess the degree of certainty. So degree of certainty attached to the flow of future economic benefit must be assessed based on the evidence available at the date of initial recognition, that is normally date of purchase. So management say I'm purchasing a machinery. Okay, so machinery at that time I need to assess, okay, how much, what is the production capacity, for how many years I'm going to get the production. And so based on that, we see that, okay, this is the bare minimum production. So that assessment has to be done at the time of initial recognition. So if we believe that, yes, future economic benefits will be there, then only we should move forward. So likewise, say, for example, I am buying a machinery for a production of a new, some say, machineries purchased for some new product. So I need to assess that, okay, I am going to manufacture a new product by using this machinery. So this product will be sold into market and that will generate benefit for me. So how I am confident about the same? That assessment management has to conduct at the time of initial recognition. The first criteria, future economic benefits. So economic benefits means revenue or savings of cost, both. Second condition is, say, reliable measurement of cost. So generally easy to measure the cost, because when we say purchase an asset, so the amount of consideration what we are going to pay to our supplier will become my cost. If we are constructing asset of our own, like say we are constructing our own building, so in that case my cost can be material plus the labor, material part, etc. So whatever amount we are paying to external parties, that will become my cost. So purchase of asset, finding out cost is easy, the price what we are paying. Self construction also, we can add different costs, like I can say add cost of material, I can add cost of labor charges, I can add cost of variable overheads like electricity consumption, fuel consumption, etc. I can add the cost of fixed overheads, like if any rental we are paying, kind of thing. So that measurement can be done. But when there is an exchange of asset, so we are not purchasing or we are not constructing, we are doing exchange of the asset, barter system. So one asset I am giving up, other asset I am receiving up. So in that case, what is going to be cost of asset? So standard says that fair value of the asset given up. So asset what I am giving up, what is my outflow? Market value of that asset will become my cost. So if fair value of the asset given him is not available, then fair value of asset received when exchange has a commercial substance. So first priority, again, say when there is an exchange transaction, we have to consider fair value as a deemed cost. So first preference is always fair value of asset what we are giving up. If that fair value cannot be measured, then we will consider the fair value of asset what we are receiving. But in both the cases, the transaction which is happening, exchange transaction, it must be having a commercial substance. Commercial substance means because of this transaction, the transaction should impact cash flow of the company. Then we can say there is a commercial substance. So when there is no commercial substance, or say fair value, which is say market value of asset is not available. So the asset what I am giving up or asset which I am receiving, none of the fair value is available. Then what will become my cost? So the carrying value of the asset given up. So carrying value means as on the date of transaction, what is the value of asset in my balance sheet? That is my carrying value. And that asset I am giving up. So the cost carrying amount of old asset will become my carrying amount of the new asset which I am receiving. That is cost measurement in case of exchange of assets. Right? So cost measurement is important. At the time of purchase, pretty simple, the amount what we are paying. Construction, amount what we are paying to different external parties like suppliers, laborers, overheads, etc. Exchange of asset, fair value of asset what we are giving up. If it is not available, then fair value of asset what we are receiving. If both are not available, then carrying value of asset what we are giving. Some important say separate items like small items like tools, dies, molds, etc. So they are recorded as inventory. But the major parts, major spare part or major components, they are recognized as property, plant and equipment. These are some specific cases that, okay, how to deal with the spare part. So we have to see what type of spare part it is. If the spare parts are the important component of the main machinery, major part, they are bigger parts. So they were recognized as property, plant and equipment, but like small equipment, small tools, they will be recorded as inventory. Safety and environment equipments. So safety equipments like my, say, fire system into my office, they are not going to generate any economic benefit. But these are equipments are required. So other assets which generate economic benefit, they can operate appropriately. So like we have air conditioners into our office so that our computer systems can be there in adequate, say, temperature, room temperature. Server room requires a cool temperature. So these equipments are not going to generate economic, but these are necessary. So our other assets can operate abroad. So these are also recorded as asset. So safety and environment equipment like your, say, fire system, air conditioners, etc. So these are can be recorded as an property, plant and equipment. So after recognition, it comes about the measurement. So once these criteria are fulfilled, that yes, future economic benefits are also there, cost also can be measured reliably. Okay, then it comes measurement. Measurement are of two types: initial measurement and subsequent measurement. Initial means when we are recording an asset for the first time, and subsequent means once it is recorded, what would be the measurement afterwards. So when I'm talking about initial measurement, that is recording an asset for the first time, initial measurement is always at cost. Always. All the assets, not only property, plant and equipment, all the assets, whenever we are recording an asset for the first time, it is always at cost. Yeah, IS 41 agriculture standard, which we discussed a brief about bearer plant and all. This is the only standard where initial measurement is not happening at cost. Over there, the initial measurement is happening at fair value. But otherwise, all type of asset, tangible, intangible, financial, non-financial, all the assets, first time recognition is always at cost. So when I'm talking about cost, the question will come, what should be included into my cost? So my cost includes purchase price, import duties, import, like say, if I am buying an asset from the overseas market, so I have to pay some import duties, if any, so that will be part of cost. Non-refundable purchase taxes. So indirect tax, what we pay, like value added tax or whatever the term we use. So if I can take credit of the same, input tax credit, then it is not part of my cost. But if I am not able to take the credit of the input tax, what I am paying to my supplier, then it is part of my cost. Then directly attributable cost. Directly attributable means if I am not purchasing this particular asset, so the expense what I'm incurring right now, that also can be ignored, because just because of this asset, I'm incurring this extra expense. That is called directly attributable cost. So directly attributable cost to bring the asset to working condition. So working condition, like say cost of site preparation, initial delivery charges or handling cost, installation cost, testing charges, professional fees to architects and engineers, any borrowing cost. So this all are directly attributable costs. This will also be part of my initial cost of property, plant and equipment. Then we have dismantling cost, that is cost of removal or a cost of restoration at present value. So dismantling cost means, let's say I am buying an asset, I am buying a machinery. Now to install this machinery, I need to first of all construct a platform. Platform from say a wooden platform I need to prepare, and on that wooden platform only I can install this machinery. This machinery has a useful life of 5 years. So after 5 years, when this machine is of no use, so I need to remove that platform also. So that is cost of removal or cost of, let's say, dismantling. So we are going to incur some cost after 5 years to remove that. Now, why we are going to incur this cost after 5 years? Just because we are right now purchasing this machinery. So this is again a directly attributable cost. So entity has to make an estimate that how much it has to pay after 5 years. But this is a future value. I need to recognize asset today. So whatever is my estimate of the cost, which I may have to pay after 5 years, I will discount it and I will find out the present value of the same and I will add into the cost of asset. So again, initial measurement of cost is purchase price, import duties, if any non-refundable taxes, indirect taxes, directly attributable cost, and the dismantling cost that we need to take care. Any questions so far? Any question, guys?
For a while, no.
Okay. Fine. So let's have a break for 10 minutes again, and then we'll move on for the rest of the part. 10 minutes break, guys.
Thank you.
Thank you.
I think that is it, but we can start.
There. Let's wait for a couple of minutes.
Okay.
Cecilio, if you're ready, let me know. We can start then. All right. Let's start then. So, a question. If an oil rig was built into sea, the cost is to be capitalized is likely to include the cost of constructing the asset and the present value of cost of dismantling it. If asset cost 10 million to construct and it would cost $4 million to remove in 20 years, the present value will be calculated as follows. So let's do this in Excel. The question says, say cost of construction of oil rig is $10 million. Life of this oil rig is 20 years. and dismantling cost is expected to be 4 million. So after 20 years, when this the oil extraction activity will be completed, so entity has to remove this oil rig from the seawater, and for that, their estimated cost is 4 million. So this is an asset. I need to record this as an asset today. So I need what is the cost of oil rig? So it will include cost of construction, which is 10 million, and dismantling cost, or I can say cost of removal at present value. So for this 4 million is a value which I have to incur after 20 years. If I have to dismantle today, how much I have to pay? So this 4 million has a definitely will have an inflation effect of 20 years. So I need to find out present value. Present value formula is future value into, say, 1 divided by 1 plus R. R is the rate of interest which is applicable to entity raised to n. N means number of years. Rate of interest given here is 5%. Rate of interest 5%. So present value is going to be future value is 4 million. 1 divided by 1 plus R, that means 1.05 power 20 years. So present value of the same is this 1.5 million. So asset will be recorded with a cost of 11.50 million. This is my initial measurement of the oil rig. So journal entry that we are going to pass here is oil rig account debit. I am creating an asset. Value is 11.50 million. To bank account, construction cost we are paying right now. That is 10 million. But this 1.5 million I'm not paying right now. I have to pay this after 20 years. So what to credit? To provision for dismantling cost. So this will be this one. This is the entry of initial recognition. So simply what we are doing, 4 million is a value that has to be paid after 20 years. So out of 20 years, we are removing the time value of money effect and we are finding out the present value. Then this provision, we need to say unwind the discount, year number, opening balance, interest at the rate of 5% and closing balance. So year number 1, initial recognition, this is the value. Now we will come at the end of first year. So end of first year means, okay, we have discounted this. So now we have to unwind the discount. So 5% on this. And this is closing balance. So if we do same process at the end of 20 years, this will become 4 million. So every year we need to calculate interest like this. So first year closing will become second year opening. Again, interest on the same and so on. This we need to follow till 20 years. So at the end of 20 year, this will become 4 million. So at the end of 20 year, we will now dismantle that oil rig, will make the payment, provision will become 0. So at the end of first year, one more entry we have to pass is interest expense debit to provision for dismantling cost, provision amount will increase accordingly. 75,000, 75,000. So we recorded initially with this value, interest will be added at the end of first year, value will be 1582. Now, why we are doing this? So simply I am going to pay 4 million, but this is after 20 years. If I have to dismantle today, I have to pay only 1.5 million. So I cannot record asset with the future value. Yeah, I'm not doing today. I will dismantle after 20 years. So I'm getting 20 years of time. So instead of 1.5 million, I will pay 4 million only because I will get 20 years of time. So that will be recorded as an financing component interest expense on the provision. And this oil rig will be depreciated over a period of 20 years. So on that, we will provide, say, let's say if we are providing straight line basis of depreciation, debit to accumulated depreciation. So 20 years is the life. So this divided by 20. Right. So this is how the present value asset initial cost is being accounted for. Again, a very basic question, but whenever we have, say, we are incurring any expense on this machinery or say any of the asset, why we do not charge it to statement of profit or loss and we create asset for the same? Very basic but important question. So say, for example, I am purchasing machine today, so I am making full payment today. So for me, cash is out. But still, I'm not putting this into statement of profit loss and I am creating asset. And then I'll provide depreciation. What is the reason behind the same? Can anyone help? Which concept applies here? Which accounting concept will come into picture? My simple question is, if cash outflow is happening with me today, then why I should not account full expense in the first period? And why I'm creating an asset? So this oil rig I am installing today, but I am creating asset and I am recording this into balance sheet. But why I am not recording the same into statement of profit loss? Is my question clear?
No, I think that we can make it more clear. The question.
Sorry.
Please make it more clear, the question.
Which accounting concept? Matching concept. Have you heard about what matching concept says? We have to
Matching
match.
concept, yes.
Yes. So matching concept says that we have to match our expense against the income. So for example,
Yes.
if I am recording income of $100 into my statement of profit loss, so the expense which I have incurred to earn that $100, that only should be accounted, not a single dollar extra, not a single dollar less. So this is an oil rig which I am going to use for a period of 20 years. That means this is going to generate economic benefits for the entity over a period of 20 years. So if I record full cost in the first period, so in first period, there is a huge amount of cost, but comparatively economic benefit or maybe revenue will be only for 1 year. Second year onwards, there will be only revenue, against that there is no corresponding cost. So matching cost concept will be compromised there. So that is the reason where the assets which we are able to use for more than one period and which are going to generate economic benefits for more than one period. So we do not charge them to statement of profit loss and we create asset and then provide depreciation. So over a period of time, we transfer cost from balance sheet to statement of profit loss by the way of depreciation. Fine. Is this okay?
Oh,
So in this case, this 75,000 interest will go to my statement of profit or loss. Depreciation will go to statement of profit or loss. And at the end of first year, into my balance sheet, there will be an oil rig with a balance of, so initial recognition is 11.50 minus first year's depreciation. This will be carrying value, and provision will be there in my liability with this value. So statement of financial position, what are the items? Statement of profit or loss, what are the items? So if I just prepare the quickly small statement of profit loss, extract of statement of profit or loss. So into my statement of profit or loss, depreciation cost is this much, and interest on dismantling cost, this is my two items will be recorded into statement of profit or loss, and then statement of financial position. So on asset side, I will have under non-current asset, I'll have oil rig. So that will be oil rig value. This accumulated depreciation will be part of this grouping only. So we can see the net carrying value, this, and on liability side, under the heading non-current liabilities, will have provision for dismantling cost, and this will be this value. So this is how this transaction will look like into our financial statements. Moving forward, some important points. Say any proceeds received from the selling items made during such testing should be credited to statement of profit loss. So for example, we developed, say we purchased the machinery, and for the testing purpose, we are say running a test run, and we are say producing some units. Now those units we are selling, so that we can record as an income into statement of profit or loss. Another important point is income and related expense of the operations, which are incidental to the construction or development of the item of property, plant and equipment should be recognized into statement of profit or loss. For example, let's say we want to construct a building. But before building is constructed, first of all, we are doing this site preparation. So land value, say, just say land clearance, land preparation. So maybe so that activity. And before the construction of the building starts, for some period of time, say for 3 months, that plot is vacant. We are going to start construction after 3 months. So what we are doing, this is a vacant plot. Okay, I'm using that as a parking, and I'm collecting parking charges for the same. So I'm temporary use parking charges, parking fees received from a vacant plot. I can record it as an income into statement of profit or loss. Okay, so this is important. This normally happens with this, that say if my land is situated in certain area and building construction is not yet started, and I can generate some income out of this using it as a parking place. So it can be recorded as an income. Following cost should never be capitalized. like any administration or general overheads, always charged to statement of profit or loss. Any abnormal cost like repairing, wastage, or any time where the asset is ideal will go to statement of profit loss. Cost incurred after asset is ready for use. So again, important part here is, now say when we purchase the asset, it is fine. The asset is ready condition, or maybe after installation, it will become ready. So we are talking about capitalization of cost. So till which point of time we can capitalize? So cost can be capitalized till the point of time when asset is ready for use. Once asset is ready, after that, any expense incurred on that asset cannot be capitalized. That is called subsequent expenditure, and it will go to statement of profit or loss. Cost incurred into initial operating period. So maybe a new operation has started. So initial operating loss or any further cost incurred before machine is used at full capacity. This will be also be cannot be recorded as cost. Cost of opening a new facility or introduction of a new product, that is like advertisement or promotional cost. Conducting business at new location or with new class of customer, including any training cost to the employees. This is also cannot be part of your cost of asset. Cost of relocation or reorganization, that is also cannot be part of your cost of asset. So these are never included into cost. Okay, one question we have. Entity started construction of the building on its own use on 1st of April 2017 and incurred following cost: purchase price of the land, stamp duty, legal fees, site preparation and clearance, materials, labor, architect fees, and general overheads. So total cost incurred is 583,000. Few additional information is provided. Say material costs were greater than anticipated. So on investigation, it was found that material costing $10 million has been spoiled and therefore wasted. Further 15 million was incurred on material as a result of faulty design work. So the term here, what we have seen, any kind of abnormal cost cannot be capitalized. So here material used which is more than anticipated. So we have an estimate, okay, this much of material is required, but some material has spoiled. Spoiled means that material has never used in the construction of building. So that is my abnormal loss. Okay, it cannot be part of my cost of building. Second, 15 million material, there was a fault into designing. If design was appropriate, there is no, this cost could have been ignored. So this is also abnormal cost, abnormal loss, cannot be included into cost of building. Second information given, as a result of these problems, work for the building ceased for a fortnight during October 2017. So because of these material issues, the work was temporarily suspended. Laborers were not working for 15 days. So as labor was not working, they are not contributing to the construction of the building, and 9 million of the labor cost belongs to this. So here also we have seen that ideal time, it is also my abnormal cost. So that is also cannot be considered as a part of cost of asset. So the question is, you are required to calculate the cost of building that will be included in tangible non-current asset additions. So if I put this here, cost of building, So first I have purchase price of land. Okay, purchase price is part of my cost. $250,000. Then we have stamp duty, again directly related cost with regards to land. Stamp duty 5,000. Legal fees, so to pay the stamp duty, registration of land, deed, etc., what any legal charges we are paying to lawyer, directly attributable cost 10,000 added into the cost of building. Then we have site preparation, directly related cost again, site preparation and clearance 18,000. Now total material costing is 100,000. Total is 100, but out of which, as we have seen in the additional information, 10 million was spoiled, so that is abnormal loss, and 15 million was because of the fault into design, so that is also abnormal. So 100 into minus 10 minus 15, so that will be 75,000 only will be included into cost of assets. So out of this 100,000, 25,000 was abnormal loss. That will go to my statement of profit or loss. Into cost of building, only 75,000 can be added. Then labor is 150,000. So into that also there is some ideal time of 15 days, and for that 9 million is paid. So that also 9 million will go to statement of profit loss. Into cost of building, only 141,000 is added into cost of building. Then we have architect fees, which is 20,000. And we have general overheads. They are always charged to statement of profit loss, so this will not come into cost of building, 0. So the question is, at what value building should be recognized initially? So building cost is 519,000. This is the value with which building will be recorded for. Is this fine?
Yes.
Okay. Now talking about the subsequent expenditure. Subsequent expenditure means once asset is initially recognized. So that means once asset is ready for use, after that, any expenditure happening with regards to that particular asset is called subsequent expense. Now, normally subsequent costs are always charged to profit or loss as a revenue expense. But in few circumstances, even subsequent expenditure can also be capitalized into cost of asset. So there are 3 situations where subsequent cost can be capitalized for. Number 1, when it enhances the economic benefits provided by the asset. See again, when we saw that recognition criteria, future economic benefits and reliable measurement of cost. So that time we discussed that this criteria we have to apply at the time of initial recognition as well as subsequent expenditure. So as a part of subsequent expenditure, when we do any repair cost to the asset, or maybe we do any maintenance activity, that is not going to generate any future economic benefit. So these kind of cost we charge to statement of profit or loss and not as an asset. But when we see that because of the subsequent expenditure, number 1, if it results into enhancement of economic benefits. First point. If it enhances economic benefits provided by the asset, then it can be capitalized for. If future economic benefits are there, cost, so anyway we are measuring reliably because the cost what we are incurring, so it can be capitalized. Now how it can happen? So maybe because of the subsequent expense, there is extension of the useful life. So previously maybe say the asset was usable for 5 years. Now the same asset we can use for 7 years. That means for now 2 more years we can get economic benefits. So the same cost I can add into the cost of asset. Now why I'm adding? Again, matching concept. Because this will result into increase of future economic benefits. Life is increasing from 5 years to 7 years. So I am going to get benefit from these assets in the year number 6 and 7. So my cost also should go against that in 6 and 7 year, and therefore we are capitalizing it into cost of asset and then will provide depreciation on the same. So number one situation where subsequent expenditure can be capitalized is enhancement of economic benefits. Second is relating to an overhaul, or we can say the major inspection on the asset. Now this basically, let's say this kind of situation comes where the asset like aircraft or maybe a huge ship which which is used for the conveyance of the human life, aircraft. Now aircraft is such an asset again which security is again a very important part as far as aircraft is concerned. So let's say for example by the rules itself, engine of the aircraft requires inspection every 5 years, and that is again a very major inspection. If you do not do this major inspection on the engine part, then engine cannot be used for further period. That is again, it is by the law itself. Let's say for example. So that is the inspection cost what we have to incur every 5 years. That is called overall cost or major inspection cost. Now standard says that this cost we can capitalize into cost of asset. How? Let's say this works like this. Major inspection or overhaul cost. So let's say for example, entity purchasing an aircraft with a cost of say 25 million, useful life of 20 years, engine of aircraft requires major inspection every 5 years. So standard says here, because the norms are such that an inspection has to be carried every 5 years. So let's say you assume that engine has a useful life of 5 years only. If you are not going to do this inspection, you cannot use the engine anymore. So engine has a life of 5 years only. So standard says that in these cases, you have to, at the time of initial recognition only, you have to split this asset into two parts. So like say, this is my 25 million, this is my total aircraft. I need to split this in say two parts. Number one is say engine part, which I can say overhaul component. And second one is rest of the aircraft. So standard says that you divide this 25 into 2 for engine and for the rest of the part of the aircraft at the time of initial recognition only. Okay, so how much is the value of engine in this 25 million? So standard says that for that you see that, okay, if entity has to conduct an inspection today, that means at the time of initial recognition only, what should be the cost of inspection? So inspection cost at the time of initial recognition is, let's say, for example, 5 million. So standard says that this total 25 million, out of which 5 million is for engine component and 20 million is the value of remaining aircraft. So that means at the time of initial recognition, that is year 0, starting of year number 1, I'm considering it at year number 0. So I'm recording asset, but with two different components, engine component and rest of the aircraft, 5 and 20. Now, as we discussed, engine cannot be used unless the inspection is carried out every 5 years. That means I have to presume that engine has a life of 5 years only. So engine will be depreciated over a period of 5 years. So 5 divided by 5, annual depreciation is going to be 1 million. Rest of the aircraft will be depreciated over the total useful life, which is 20 years. So here also annual depreciation is going to be 1 million. So end of 5th year, carrying value will be 0 for the engine, and this will be 15 million. So the depreciation expense, what we are going to record in statement of profit loss for the first 5 years is going to be 2 million. 2 million will go to profit or loss for year number 1, 2, 3, 4, 5. Now we are at the end of 5th year. Now we will conduct this inspection. So standard says that, okay, at the end of 5th year, whatever is your actual cost of inspection, say inspection cost, let's say 6 million is happening. So this 6 million you add into cost of asset rather than charging it into profit or loss. So at the end of 5th year, we are doing this inspection cost 6 million. Here there is no inspection required. So this will remain 15 only. So now what is the situation? 6th year starting, or we can say at the end of 5th year only, this will become 6 and this is 15 only. So total value of asset is now 21, carrying value. So this we are adding into cost of asset. Then they are saying, okay, now next 5 years. So here number 6, 7, 8, 9, 10. So this 6 million will be depreciated over next 5 years. This divided by 5, that is going to be 1.2. This is normally remaining life is 15 years. So this is 1 million only. So from year number 6 to year number 10, our annual depreciation is going to be 2.2 per annum. Again, now we are at the end of 10th year. Second interval of 5 years is completed. End of 10th year. So again, this is 0 now. And this is a carrying value, 10 million. Again, say whatever cost incurred, let's say now at whatever the actual cost we incur, let's say it is 4 million. So we will add this into cost of asset. And after that, revised carrying value will be, now engine has a value of 4 million. This with the 10 value. And again, will now this 4 million, we will depreciate it over next 5 years period. That is year number 11 to 15. After 15th year, we'll do the same process next 5 years. So this is how this major inspection cost is being accounted for. So engine part, we have to split, and it will be depreciated over a period of 5 years. Is this okay? So every 5 years, we need to repeat the same process. Are we good on this? Any questions, guys? Any question?
Yes.
Yeah.
I confess that this is new for me.
Yeah, this is how this is being accounted.
And yes.
So you understand,
Maybe
right?
with some exercise, we can get there.
This will only in case of this large assets like aircraft and all. Rest of the assets, we do not apply this accounting. But point is, this is subsequent expenditure that we have to incur once aircraft is purchased. That means it is initially recognized. But after that, we have to do this inspection cost. But when it is because of some regulations or some law, we have to do it regular. This is a major cost. Then we'll apply these accounting that we split the total asset into two parts, and engine part will be depreciated for a period of 5 years. And then we'll do expense, then again 5 years, then we'll do again expense next 5 years.
Okay.
Right. So same process will follow at the end of 15th year also, and at the end of 20th year, a useful life is over. So asset will become zero then. All right.
All right.
Everyone, no confused question on this?
No, I have no question, but for me to this is something new. So I think that if the end we have this,
Yeah.
we can solve it, or we can try to understand
Yeah,
better.
you can, we are facing some anything similar kind of issue within your, say, organization. We can discuss that later on. Yeah, that's not an issue. We'll discuss that all the queries if you have with regards to your day-to-day operations also. So this is the second case where the subsequent expense can be capitalized for. Third one is replacing a component of a complex asset. Complex asset means which is made of number of components and with each depreciate at different rates. So this could be aircraft also can be an example. Let's say, for example, if we talk about a textile industry, so into textile industry, into factory, there is an asset called boiler which is used. Now, boiler is a huge asset, but it is made of different components. Now, after these, when say one of the component is not in a working condition, so we have to replace that component. So standard says that when you replace this component, you can add this into cost of asset. But before you add the cost of a new component, first of all, you have to de-recognize the original component, which is of no use now. So any value, any carrying value of the original component, which is now not usable, de-recognize it, and then add the cost of new component into cost of asset. So there's three situations. Number one, where the future economic benefits are enhancing, replacement component, and the major inspection cost. In three cases, subsequent expenditure also can be capitalized into cost of asset. Otherwise, other cases, the subsequent expenditure will always go to statement of profit or loss. Another question is, say a piece of machinery has annual service costing $10,000. During the most recent service, it was decided to replace a part of engineering, meaning that it will work faster and produce more units of product per hour. Cost of replacement part is 20,000. So would this expenditure be treated as capital expenditure or a revenue expenditure? So first is my annual service cost of 10,000. Now this annual service cost, again, see I have to see the rules when I can capitalize, when future economic benefits will be there. So my normal annual service cost is not resulting into any future economic benefits. So annual service cost 10,000 cannot be capitalized. It will go to statement of profit loss. This is my revenue expense. But now we are doing some replacement with the cost of 20,000. Now what will happen because of this 20,000? My machine will work faster. Work faster means it will able to produce more number of units. More number of units means more economic benefits. So because of this 20,000 cost, my future economic benefits are increasing. And when my future benefits are increasing, second condition is reliable measurement. Of course, I know that I'm spending 20,000. So I know the cost very well. So both the conditions are satisfied. So this 20,000 can be treated as a capital expenditure and it will be added into the cost of non-current asset. This is the same question what we did in Excel, the aircraft one. So I'm skipping this. Okay. Now, next point to discuss is depreciation. So as we discussed about the matching concept, so where say an asset where we can get economic benefits for more than one period, so we capitalize them instead of charging to profit loss so that our income and expense can be matched with. So for example, say asset has a life of 5 years. That means I am going to get economic benefits after the asset for a period of 5 years. So I need to allocate the cost of this asset over a period of 5 years. That is called depreciation. So depreciation is what? Systematic allocation of the depreciable amount of the asset over the useful life. Systematic allocation. Now you see how you can match. You can follow straight line basis. You can follow written down value basis. Anything. Depreciable amount means cost minus residual value. Residual value means any, say at the end of life, if I'm expecting to receive any scrap value, or maybe I'm expecting that, okay, life of the asset is 10 years, but I am going to use only for 5 years. And after 5 years, I'm going to sell this asset. So how much amount I'm expecting to receive when I'm going to sell this? So that is called my residual value. So depreciation formula is what? Cost minus residual value divided by useful life. So a few important points about the depreciation. So all the property, plant and equipment with a finite useful life must be depreciated. So all the assets which have a definite life, 5 years, 10 years, 15 years, whatever it is, must be depreciated. Depreciation is always charged to statement of profit or loss unless it is included in the carrying amount of another asset. Now, meaning of this is, let's say, for example, we have another standard on intangible asset. Into intangible asset, there is an expense called development expense. So let's say, for example, I am say developing a new, let's say, if we talk about that COVID situation. So let's say the pharma company is there, which is in the process of developing a vaccine for this COVID disease. Now, in the development of this, they are using one specific equipment. Now, equipment is normally considered as property, plant, and equipment. But it is a very specific to that development. Elsewhere, this cannot be used. Now, intangible asset IS 38, International Accounting Standard 38, which talks about the intangible asset. It says that development cost, if certain conditions are fulfilled, it can be capitalized as an intangible asset. Condition I'm not talking right now. If certain conditions, say all conditions are fulfilled. So whatever cost I incur to develop a, say, a COVID vaccine, that I will record as an intangible asset. Over there also same logic applies. For intangible asset, we provide amortization. So amortization is provided on these kind of development cost when the commercial production is started. So my vaccine is ready, then I will start commercial production of the same, and then I will start generating revenue. So again, matching concept says that your development cost, you should match with the period in which you are getting benefits. So when commercial production is started, I'll start generating economic benefits. So against that, I will record cost. So the equipment, again, equipment, what I'm using in the development project. Okay, normally we have to provide depreciation as per property, plant, and equipment. But this depreciation, I will not charge to profit loss, because against that, there is no corresponding benefit. So this depreciation, I will add into the development expense. Development expense will be recorded as intangible asset. And when the commercial production will start, that intangible asset will be amortized in the statement of profit. So normally depreciation is charged to profit loss unless it is covered by carrying amount of any other asset. So this is with reference to that. Depreciation should be charged to each significant part of the item of property, plant, and equipment separately. So maybe we have an asset with different components, and different components have different useful life. So on each component, we have to provide separate depreciation. From which date we have to start providing depreciation? So depreciation begins when the asset is available for use. See, very important word is when the asset is available for use or ready for use. So even if, say, asset is ready, but entity has not yet started using it. So even if asset is idle, depreciation has to be provided for. So this may be earlier than the date it is actually brought into use. For example, if staff need to be trained to use it. So initially, okay, machine is ready for use, but initially staff is being provided training, and after that machine will be start for the use. So even though initial period when there is a training phase, depreciation has to be provided. So there are two words important: ready to use and put to use. Put to use means use of the asset is started. Ready to use, that means asset is ready but not yet. So depreciation has to be started from the date when asset is ready for use. How to provide depreciation? So depreciation must be allocated on a systematic basis, reflecting the pattern in which the future economic benefits are expected. So again, matching concept, income and against expense. So you decide what is the best way to provide depreciation so that the profit and loss statement can provide an accurate profit. So we can use straight line basis, or We can use written down value method, or we can use machine hour method also. So depreciation method based on the revenue generated. So they are saying it is a systematic allocation. So systematic allocation, say someone can argue that, okay, I have to follow matching concept. That means I need to match my expense against income. So I will provide depreciation based on revenue. But standard says that no, depreciation method based on the revenue generated by the activity, they are not appropriate, because revenue reflects many other factors like inflation, sale price, sale volume, and not only the economic consumption of the asset. So you cannot consider provide depreciation based on revenue. Depreciation method should reflect as fairly as possible the pattern in which the economic benefits are consumed. So different methods, average, straight line, reducing balance, machine hours. And if asset is classed as a complex asset, that means say having separate component within single asset, then each separate part would be depreciated over a useful life. Then into depreciation only, change of depreciation method. So first of all, again, there are two important terms into accounting. Is one is accounting policy and second one is accounting estimate. Change into accounting policy is not allowed in a normal circumstances, unless the accounting policy change is the requirement of any accounting standard, or it can be seen that if we change the accounting policy, it will result into more relevant and faithful representatives. Then only accounting policy change is allowed. There is no such restriction in accounting estimate. So the question is, when say if entity is changing the method of depreciation. So first question again will come, whether this change in the method of depreciation is a policy change or an estimate change. So this is considered as a change in accounting estimate. Policy is what? Policy is to recognize the tangible asset which can be used for more than one period as an asset and then depreciate on a systematic basis. That is a policy. But which systematic basis we are going to choose, straight line, reducing balance, or machine hour, that is an estimate. Another important point where I have to bifurcate whether it is a policy change or a estimate change. So whenever because of the change results into the change into measurement, change into recognition, or change into presentation, then only it is an accounting policy change. Let's say, for example, if I talk about recognition. So same example which we discussed about development cost just a while before. Now development expense is an expense where two possible treatments are possible. I can record it as revenue expense also, and it can be capital expense also. So if certain conditions are fulfilled, it is capital expenditure, otherwise it is revenue expense. So what is happening previously when entity started development? So in the starting phase, all the conditions which are necessary so that this can be capitalized were not satisfied. So initially company used to account development cost as revenue expense into statement of profit loss. Later on, all the conditions are satisfied. So after that, company has to capitalize the same. So see, recognition has changed. Initially, the expense was recognized as revenue expense. Now it is recognized as capital expense. So this is considered as a change in accounting policy. Second one is change of measurement. So we will see in a while that property, plant and equipment provides, say, cost model of accounting and revaluation model, same based on framework, current value and say historical cost. So initially say company doing historical cost and then moving on to current value. So measurement is changing. That is also change in accounting policy. Third one is presentation change. So previously say depreciation was recorded as a part of cost of sale. Now company is changing it from cost of sale to administration expenses, presentation change. So this is also accounting policy. So this three cases where the change is coming into recognition, measurement and presentation, then only it is an accounting policy change. Now when the depreciation method is changing, there is no impact on recognition. Recognition was asset is already there in balance sheet. Now also it is the same. Measurement, no changes. Presentation also going to remain the same. Only the estimate that, okay, previously maybe I have an estimate that asset can be used for 10 years. Now asset can be used for 9 years. So I will change my depreciation accordingly. This is my change of accounting estimate. And it can be accounted with prospective effect. So let's see one question. So asset costing 100,000, expected life 10 years. The buyer intends to use the asset for 6 years, at which point the expected residual value will be 40,000. So what is the depreciable amount? So depreciable amount is your cost minus residual value. So I want to use this asset for 6 years only. After that, I am planning to sell it. So that is my residual value. So 100 minus 40, 60,000 is my depreciable asset. And 60,000 I am going to depreciate over a period of 6 years. Another very important point is about the estimates. So very common rule of the, say, framework is said wherever the estimates are used. Estimate means assumptions, they are not accurate values. Estimates are made based on the information available on a specific date. So how we prepare financial statements? If you see the date, what we prefer, statement of financial position as at 31st December 2024. So we provide on specific date information. So framework say that wherever the estimates are used, entity has to review this estimate every year, at least once. So useful life of the asset, again, it is an estimate. So initially when I purchased, okay, asset was 10 years. Okay, then my asset got damaged. So now my estimate changed that now I can use this asset for only 6 years. So every year this review has to be conducted. Is there any change in the estimate or not? Residual value is also estimated amount. Depreciation, as we discussed, that is also an estimate. So wherever the estimates are used, annual review has to be conducted, that is there any change in the estimate or not. And if any change is there, then it will be accounted with prospective effect. That means in the year of change and the period afterwards. So one example on the same, say B company acquired non-current asset on 1st January 2012 for $80,000. Zero residual value, life is 10 years. On 1st of January 2015, the remaining useful life was reviewed and revised to 4 years. So what is happening now? What will be the depreciation for 2015? So in January 2012, we purchased asset for 80,000. Then we use this asset for 3 years, that is 2012, 13 and 14. So my estimated life initially was 10 years. So we provided depreciation for 3 years. 80,000 divided by 10 multiplied by 3. 24,000 is my accumulated depreciation for 3 years. Now as on 31st December, carrying value is 56,000. Now as per the original estimate, life was 10 years, but now on 1st January 2015, the estimate has changed. Now I can see that this asset I can use for only 4 years. Fine, 4 years. Then what will happen? Okay, 56,000 we will depreciate over period of 4 years now. So 56,000 divided by 4. That is from the year number 4th onwards, annual depreciation will be 14,000, which previously was 8,000. So this is how change in accounting estimates are accounted for. Then we have complex asset, like say we have different components. So one we have say fuselage, cost is 20,000, which has a life of 20 years. Undercarriage cost is 5,000, but it can the life is 500 landings only. Engine costing 8,000, life is 1,600 flying hours. So during the year number 1, total flights landed 150 and flying hours were 400. So calculate depreciation. So we need to say simple different depreciation on different component. This has 20 years life. So on this depreciation is going to be 20,000 divided by 20, 1,000. Undercarriage total cost is 5,000 and total life is 500 landing. Out of which current period landing is 150. So current year's depreciation is 5,000 into 150 divided by 500. And same goes with the engine. Total cost is 8,000. Total flying hours are 1,600. That is total life. Current period flying hours is 400. So 400 divided by 1,600. So this is the total depreciation that we have to provide for the period. Any question so far? Are we good on this?
Yes, this example is to understand.
Yes, I agree.
Sorry, I didn't get your question.
I say that for this example, it was easy to understand the example.
Okay.
This explanation and the numbers, the figure.
Yeah,
the
this
figures.
is normal. This is not very simple. All right.
Yes.
So, okay, let's have break for 10 minutes, final break, and then we'll conclude the rest of the part. So we'll resume in next 10 minutes. Yeah.
Okay, thank you.
So we discuss about the definition of property, plant and equipment, then recognition criteria of the plant and equipment, then into initial measurement always at cost. After cost, we discussed about the depreciation. Now talking about subsequent measurement. So subsequent measurement means once asset is initially recognized. What are the options for measuring the asset? So as we discussed in the framework provides two measurement bases, historical cost and current value. So based on that, property, plant and equipment also provides two options. One, cost model. Second one is revaluation model. Into framework, we have seen that current value means either it is fair value or it is value in use or it is current cost or a replacement cost. So out of this three, when I'm talking about revaluation model, revaluation means fair value. So once asset is recognized initially at cost, after that entity has a choice whether they want to apply cost model. Cost model means your cost, and then you will provide depreciation on the same as per the systematic basis. And if any impairment come in future, so you will provide impairment loss. So say if I have applied cost model for an asset, so, and I need carrying value today, what is the value of asset today in my books of account? So how I will get cost minus accumulated depreciation minus impairment losses, if any. What revaluation says? Revaluation says that remeasure carrying amount of the property, plant and equipment to to fair value whenever there is a material difference between the carrying amount of the property, plant and equipment and its fair value. So say if you are choosing to apply revaluation model, then you have to see, say if the carrying value means the value which is there in your balance sheet, and fair value of the same, if there is a material difference. Let's say for example, I have a building is recorded with $5 million into my books of account, that is a carrying value, but market value, or I would say fair value of the same as on date is 6 million. So there is a difference of 1 million, and that is a material difference between fair value and carrying value. So in that case, if I am applying revaluation model, then I have to remeasure the property, plant and equipment. That means I have to increase the carrying value of property, plant and equipment from 5 million to 6 million. That is called revaluation model. So when we do revaluation, my carrying value will change to fair value. So in that case, if fair value, carrying value will change to fair value, then subsequent depreciation will also change, and impairment, if any, it will come in future. So revaluation means fair value minus subsequent accumulated depreciation minus impairment loss, if any. So if I'm applying revaluation, very important point is it necessary to do revaluation every year? Answer is no, because it is very clearly written, whenever there is a material difference between carrying value and fair value, then only revaluation is to be performed. The same example, if I say the building in my financial statement is with a carrying value 5 million. And fair value of the same is, let's say, for example, 5.1 million. So there is a difference of only 100,000. Now that is not material difference. So in that case, okay, if we do not revalue the asset, revaluation is required only when there is a material difference. Yes, but on each reporting date, entity has to review whether there is material difference between the carrying amount of the asset and fair value of the asset or not. So I need to check every reporting date. What is the fair value? What is the carrying value? Is there material difference? If material difference is there, then only revaluation is to be conducted. If there is no material difference, no need for revaluation. Another important point is, if item is revalued, the entire class of assets to which the item belongs must be revalued. So let's say, for example, I have 4 different buildings. So if I am doing revaluation for one of the building, then I have to do revaluation for all other building also. That means for similar class of assets, I need to apply same accounting model. Yes, for different class of assets, I can apply different accounting model, like say plant and machinery. If I want to apply cost model, permissible. For buildings, I want to apply revaluation model, permissible. So as I said, can I apply cost, historical cost and current value together? Yes, this is the case. So it is fine. So we have to decide which, again, where for which type of asset cost has to be applied for or a revaluation. So again, it depends on, we have to see nature of asset, the characteristics of the asset, and the way in which it is going to provide future, it is going to contribute into future cash flow. And we have to see which option, which model will give more relevant information to the users. So this is revaluation. Now, talking about the revaluation further, revaluation can increase the value also, and it can decrease the value also. Right? Not necessary. Revaluation will always result into increase of carrying value. Market value can go down also. So two possible scenarios. So when revaluation increases the carrying value of the asset. So value increases, that means it is my gain. It is called gain on revaluation. This gain we have to record in other comprehensive income. So in the framework when we discussed, I have a building. For building, I am following revaluation model, and there is a revaluation happening. Value of building is increasing. Let's say my 5 million to 6 million. Now this 1 million increase is not because of my operational activities. Second reason, this 1 million is just an adjustment which I am making into my books of account, just increasing the value. I'm not realizing anything into cash. Another reason, this is my business asset. So more chances are that how I will recover these, the value of the building. I will use the asset into my business, and by use of asset, I will generate future cash flow. So realizing a market value by selling an asset, chances are less. It will not generate future cash flow by sale of asset. Rather, it is more chances that it will generate cash flow by use of asset. And again, statement of profit loss is a primary source for information relating to performance of the company. And this has nothing to do with the performance of the company, and hence this is recorded into statement of other comprehensive income. In the year end, we transferred profit which is there in my statement of profit loss to retained earnings, part of balance sheet, and the other comprehensive income, this remeasurement gain, it will also be transferred to balance sheet as revaluation surplus. There will be a separate line item. So into my balance sheet, first of all, I will have, say, equity share capital. Then I will have retained earnings. Then I will have revaluation surplus, separate line item. So this is the case where if revaluation is resulting into increase of carrying value. Now, opposite situation, let's say if revaluation decreases the carrying value of the asset. So let's say the carrying value in my balance sheet of the building is 5 million. But market value of that particular building is now only 4 million. So that means I have to decrease the asset. This is called loss on revaluation. And if the revaluation results into loss, so it will be immediately recorded into statement of profit or loss and not into OCI. Reason being prudence concept. Prudence says that record your expenses and losses immediately. You provide most conservative presentation. So if losses, that means, okay, you this value has gone down. So say following conservatism, prudence says that loss to be recognized immediately. So let's say how this works. Let's say, for example, asset is purchased with a cost of 100,000. Useful life 10 years. So year number 1, asset is initially recognized at a cost of 100,000. Then entity decided to apply revaluation model for this. But during the first 3 years, there was no material difference between the carrying value and fair value. This is the scenario. So there was no revaluation in first 3 years. So company has only provided depreciation for first 3 years. So 100,000 is my cost. Useful life is 10 years. So my 3 years accumulated depreciation is going to be 30,000. So carrying value end of year 3 is 70,000. Now at the end of third year, fair value of this asset is, let's say, for example, 120,000. So now on this date, we can see there is a material difference between the carrying value of the asset, that is 70,000, and fair value of the asset, which is 120,000. So now we need to provide revaluation. So how much gain? So my carrying value is increasing from 70 to 120. So that means 50,000 is revaluation gain. So how to account for this revaluation? First, that is journal entries. So journal entry is 3 parts, 3-step entry. Step number 1, increase, or we can say, so not increase, remeasure cost of asset to fair value. Remeasure cost of asset to fair value. My cost is how much? 100,000. We in financials we record on gross basis, right? We do not provide like depreciation to asset credit. We do not do. We do depreciation to accumulated depreciation. Yes, accumulated depreciation is part of the same group, but when we look at the detailed fixed asset schedule, so we can see cost separately, we can see accumulated depreciation separately. So my question is, say step number 1 is remeasure cost to fair value. That means I need to increase the cost of asset from 100,000 to 120,000. So as entry will be asset account debit 20,000. Now asset is 120. Into my statement of financial position balance sheet, there is an accumulated depreciation of 30,000, which is no longer needed now. There is no depreciation now. So step number 2, reverse all accumulated depreciation. So accumulated depreciation has credit balance. When we eliminate it, we reverse it, it will be debited. So accumulated depreciation debit 30,000. So see, this is how my 50,000 is made, 20,000 by increasing the cost of asset. We provided accumulated depreciation into cost of asset 30,000. Now that effect we are removing. So my total, say, gross value of asset will now become 122. So step number 3, recognize gain on revaluation. So to revaluation gain, credit, this will be 50,000. So if I just put the tabular format, say my if I look at my statement of financial position, so while have an asset with gross value 100,000, accumulated depreciation 30,000, and then I have net value 70,000. So when revaluation happens, this value should be 120,000. So journal entry, when we record, so we will add 20,000 here. We will eliminate all this 30,000 accumulated loss. So see, we are total providing effect of 50,000 like this. And after that, this will become 120. This is 0. No depreciation now. So this is again 120. So now at the year end of in the end of year number 3, revaluation gain 50,000. So now revised carrying value will become 120. We are at the end of year number 3. So now what will happen? Remaining life is 7 years. And my carrying value has changed. So now we will provide depreciation over this 120,000. Remaining life is 7 years. So my revised depreciation is 17,143. So depreciation year number 4, 7143. So this is carrying amount at the end of year number 4. So therefore, see, in this table I have written the textbook saying that fair value minus subsequent accumulated depreciation. So when we do this revaluation, this is my fair value. Now the carrying value has changed to fair value. This is my subsequent depreciation, and this is my carrying value because of this. So this is called my revaluation model. Now, very important point here is, as we said, this 50,000 increase is not because of the operations of the business. It is unrealized also. So we are not recording this into statement of profit or loss. But what will happen because of this, my value has increased to 120,000. And because of that, my subsequent depreciation expense is increasing. So previously we used to provide depreciation of 10,000 per annum. But now we are providing depreciation of 17,000 per annum. And depreciation is recorded into statement of profit or loss. That means which is going to reduce my profit. So when we saw the when we see the financials and we see the profit impact, we can have a negative, say some reason where profit has decreased. But if we see any this kind of scenario and into balance sheet, if we also have revaluation surplus, so then we can understand that yes, there is the increase of expense, but increase is because of the increase of depreciation, which is actually a non-cash expense. And depreciation is also increased just because the value of asset has been increased. So there is no reason to worry. There is no, say, issues with the operations of the company. Operations are fine, but this impact of additional depreciation, additional cost has came because of the revaluation. Now, to deal with this additional depreciation also, say standard provides two options. To recover the value of the asset, we have two options. Number one, I can sell the asset and I can recover my cost. Number two, I can use the asset. By using the asset, I can get economic benefits out of the same, and by that way, I can recover cost of my asset. Let's say in this scenario, after revaluation, if entity decides to sell the asset, so of course entity will get 120,000 if they say if company go to sell the asset, so they will get 120,000. That means now they will realize that profit of 50,000 into cash. So that is a realized profit. Second option, say they use the asset. Now they are going to use the asset for the remaining period of 7 years. So after the use of asset for 4th year, we applying the logic, say the more I use the asset, the more benefit I get and I recover the cost of the same. So can I say after using, say using the asset for 4th year, some of the profit which I recorded as unrealized, but I have realized some profit to the extent of 1 year. I recovered the value. My value asset of the value has increased. I got economic benefits out of the same. So I used asset for 1 year. So to the extent of 1 year, I have realized the profit. So for that, what they are saying, I have two options. Option number one, I can keep this 50,000 into my balance sheet as a revaluation surplus. No need to do anything, because this is unrealized profit now. When this will become realized? So if I sell the asset, so I will get full cash immediately. That means this profit is realized. Or if say at the end of the life of the asset, economic life is over. That means now I get all the benefits of the asset. So that means this is realized then. So standard provides me two options. Okay, you keep 50,000 into your balance sheet only as revaluation surplus. And whenever you de-recognize the asset, that means de-recognition will happen either if you sell the asset before the end of useful life, or the useful life is over and then the full profit is realized. So at that point of time, you transfer this revaluation surplus to retained earnings. So revaluation surplus was previously was my specific reserve. Now everything is realized, so it will become my free reserve. So it will go to retained earning. So number one, either I can transfer this revaluation surplus to retained earning at the time of derecognition of the asset, or I can do annual transfer. So as I said, I used this asset for 4th year. That means out of this 50,000 revaluation gain, some amount of profit I have realized. So how much is that? So standard says that you find out that, okay, how much additional depreciation you are providing because of this revaluation. So right now I am providing depreciation of 17,000. Previously, I used to provide depreciation of 10,000. So we are providing extra depreciation of 7,143, and this is because of the revaluation. So what I can do annual transfer of, say, revaluation surplus debit to retained earnings credit 7143 7143. So as I said, I have two options. Either I can do every year, that is at the end of year number 4, 5, 6, 7, 8, 9, and 10. After that, this 50,000 will become zero. So either I can do annual transfer to the extent of additional depreciation, or I can keep this 50,000 as it is, and I will transfer full amount at the time of derecognition. Both the treatments are fine. Whatever approach you are following, whether annual transfer or no annual transfer, this has to be uh, provided as a part of accounting policy notes. Disclosures are required. Any question on revaluation till now?
By my side about revaluations, I don't have the question. So
Okay.
I think that this example was clear.
Okay,
It
thank
was
you.
possible to understand all the figures. I think that this was easy to understand.
Sorry, your voice was breaking little bit lastly. So, sorry, I understood you got this question, but any other query?
No question, no question.
Okay, okay, fine, fine. Now, as we discussed, we have to do revaluation when there is material difference between carrying value and, say, fair value. So here we see that, okay, at the end of third year, there is a material difference. Now, same thing can happen few years back also. Let's say we use this asset for another 3 years, and again there came a material difference. So again we have to do revaluation. So when the multiple revaluations has to be conducted for. So how to account for the same? Let's say when we are doing revaluation for the first time, so there are two options. Either carrying amount can increase or carrying amount can decrease. If carrying amount increase, we record it into other comprehensive income. If carrying amount decrease, we record into statement of profit loss. Then subsequent revaluation, that is second time revaluation, that time also two options possible. It can result into increase of carrying amount, or it can result into decrease of carrying amount. So let's say second time also it is resulting into increase of carrying amount. So first time also it was increase, second time also it is increasing. That means same accounting treatment. So second time also there is a gain on revaluation. This gain will be recorded into other comprehensive income, and it will be transferred to balance sheet as revaluation surplus. But another situation. Say first time when revaluation we did, the value increased, but second time the carrying value is decreasing. So let's say, for example, I'm ignoring the depreciation part as of now. Let's say this fresh question, let's say my asset value is 100,000. I recorded 20,000 gain on this. This is my revaluation gain. So this is recorded into other comprehensive income, and this is now into balance sheet as revaluation surplus. So because of that, by adding this revaluation, my revised carrying value of the asset is now 120,000. Okay, now after few years, what is happening? Say the fair value of this asset is say 90,000 only. That means I need to reduce the value from 120 to 190. Depreciation I'm ignoring just for the understanding right now. Say my value is decreasing from 120 to 90. That means first time there was increase. Second time it is decrease. So how to deal with normally when the revaluation results into decrease of value, we have to record it into statement of profit or loss. But this is the asset where we have upward revaluation before. So what standard says that whenever such scenario is coming, that means here I have to reduce the value of asset by 30,000. So first of all, this 30,000 will be adjusted against revaluation surplus of 20,000. Because we increased the value which was unrealized, 20,000. Now, because the value is decreasing, so that unrealized profit will also get wiped out. So to the extent of the balance of revaluation surplus, which in this case is 20,000, we will record loss of 20,000 into OCI, and excess 10,000 is only recorded into statement of profit or loss. Another way of understanding, let's see, when I purchase this asset, I actually incurred cost of 100,000 only. So I paid my out of my pocket 100,000. Now I can get only 90,000 out of them. So technically my actually realized loss is 10,000 only. Why 30,000 loss is coming? Because I increased the value, but that is not my out of pocket. I increased the value of asset. So that increased value upward revaluation we are removing first, and only excess part we are charging to statement of profit or loss. Is this okay? So when the first revaluation and second revaluation have opposite effect. First one was increase, second is decrease. So to the extent of the surplus available for revaluation into my balance sheet, to that extent loss will be recorded into OCI. From other comprehensive income, it will go to balance sheet. So my revaluation surplus will become zero, because now there is no revaluation. Value is itself has gone down, but value has gone down more than 100,000, which was my actual out of pocket cost. So that 10,000 is the realized loss. 10,000 we will record into statement of profit or loss. Similarly, let's say when we did revaluation for the first time, it resulted into loss. Loss means first time, so we recorded the same into statement of profit or loss immediately. Second time revaluation also same result, resulting into loss. So again it will go to profit or loss. But opposite situation. First time decrease, second time increase. So let's say my cost is 100,000. I recorded loss of 20,000 into my statement of profit loss. So value has become 80,000 now. So I recorded loss of 20,000 into statement of profit or loss. Now the value is increasing to 110,000. This is second time revaluation. So here, to the extent of loss what we have recorded in profit or loss. So we recorded 20,000 loss. That okay, this is my out of pocket loss. I spent 100,000, but I could recover only 80,000. So there is 20,000 loss. I'm putting that into profit loss. Now that situation is reversing. Whatever value the loss which you recorded, now you have recovered it. So 20 out of, say, I need to increase the value of asset by 30,000. So 20,000 will be recorded into statement of profit loss as reversal of revaluation loss. So when you do this reversal, the loss which we recorded in profit loss, that effect of the same is eliminated. But still there is a 10,000 increase, again, which is beyond my cost, beyond what I have spent. But again, I'm not realizing this right now. So 10,000 will be recorded into OCI and it will be transferred into revaluation surplus. So this is how this in first time and subsequent revaluation is being accounted for. Is this comfortable? Is this okay, guys? Please confirm.
Yes.
Oh, yes, it's okay.
Yes, thank you. So this is the table showing same effect. This is accounting for revaluation. The entry is what we have discussed. Okay. One question we have. Say entity revalues its building and decides to incorporate the revaluation into the financial statements. Extract from statement of financial position as at 31st December 2017. Building cost was 1200. Accumulated depreciation so far is 144. So carrying value is 1056. On 1st January 2018, there is a revaluation. The fair value is 1400 and remaining life on that date is 40 years. So what is the impact and how this will be presented into statement of financial position? That is a question. So say if I took this calculation, say 31st December 2017, 1056 is the carrying value. Fair value is 1400. That means 1400 minus 1056. This is revaluation gain. We need to provide 1 year calculation. So when we record this revaluation gain, asset value will become 1400. Depreciation for 2018. So remaining life is 40 years. So now we'll provide depreciation of 35. So after providing depreciation of 35, asset will be having value of 1365. So this is basic calculation. Now how this will be reflected into statement of profit or loss. So here it is given extract of the financial statement as on 31st December. So first of all, if I talk about statement of profit or loss and other comprehensive income. So into statement of profit loss, there is a depreciation of 35. That is after evaluation, value has increased, remaining life 40. Annual depreciation is going to be 35. Other comprehensive income, we have to record gain on revaluation, that is 344, which is here. Statement of financial position, under the heading non-current asset, we have land and building. So which is this 1365, 1400 minus depreciation 35. And under the heading equity, we have revaluation surplus 344. This will be below retained earnings. So first equity share capital, then retained earning, and then revaluation surplus 344. So this is how it is presented into financial statements. This is all this working. Depreciation on revalued asset, as we discussed. Two options, either I can do annual transfer or I can transfer at the time of derecognition. That entry will be revaluation surplus to retained earning. Now, important note here is, say when I am doing this transfer, so let's say, for example, if this is my balance sheet, this is my, let's say, equity section. Below that, I have equity share capital, then I will have retained earnings, and I have revaluation surplus. This retained earning is coming out from statement of profit or loss, and this revaluation surplus is coming from statement of other comprehensive income. So point here is, when we do this transfer from revaluation surplus to retained earning, so that means, do I need to record through other comprehensive income? No, it is not required. When we do this transfer, we will not record anything into statement of other comprehensive income. We will do transfer directly into balance sheet only, from retained earning, from revaluation surplus to retained earning. Here to here, we will transfer the amount. So let this 344 is here. This first we recorded into OCI and then it came here. Later on, we need to transfer this retained earning, but we will not route this through OCI. We will directly put this into retained earning. No need to reclassify. Right? So this will directly go to statement of change in equity only. Okay, what is given? Say April 2018, fair value of the property was 100,000. Remaining life 20 years. Company's policy is to revalue the property each year end. 31st March 2019, the property was valued at 86,000. Balance on the revaluation surplus on 1st April 2018 was 20,000. And this company does not make transfer to realized profit in respect of excess depreciation. So what we discussed that, okay, we can do annual transfer to the extent of depreciation, or we can keep as it is. So here it is given, company is not doing any annual transfer. Company will do transfer at the time of derecognition. So number one, prepare the extract of the financial statement for the year ending 31st March 2019, reflecting above information, and state how the accounting would be different if the opening revaluation surplus did not exist. We are asked about 31st March 2019. We are provided with the value 100,000, but that is my opening date, 1st April 2018. If I need value on March 2019, first of all, I need to provide 1 year depreciation. 20 year is the useful life. So 100 divided by 20, that is 5,000 is the annual depreciation. So after depreciation value is 95,000. Now it is given that on the same day, property value is 86,000. That means my carrying value is 95,000, but my the carrying value is 95,000, fair value is 86,000. That means there is a loss into the property. Loss we need to record what? Immediately into statement of profit or loss. So 100,000 is the value, I provide depreciation for 1 year, divide by 20. 95,000 is the value. Revalue to 86,000. That means there is a loss of 86,000, 9,000. I need to record loss of 9,000. Now, here it is given that there is a revaluation surplus. We already have 20,000 surplus balance. So as we discussed, first time increase, second time decrease. So to the extent of the balance of revaluation surplus, we can record this into OCI, and therefore see, we are recording this here into other comprehensive income and not into statement of profit or loss. So this is my financial statement extract. For the year ending 31st March 2019, my statement of profit loss will have depreciation of 5,000. There is a loss on revaluation, but I have revaluation surplus. So I will use this 9,000 loss into my statement of financial position. Now asset has a value of 86,000, and into equity. Previously, I was having balance of 20,000. Now there is a reduction of balance by 9,000. So revised value of revaluation surplus will be 11,000. Fine. This is working for the equity. Second is, say if there was no opening revaluation surplus. So in that case, 9,000 is the loss that we have to account for. That 9,000 loss will go to statement of profit loss immediately. Fine. Instead of OCI, it will go to where? Statement of profit loss, because there was no unrealized profit before. One more question we have. The entity revalued its land and building at the start of the year 10 million, out of which 4 million belongs to land, so remaining for the building. Property cost was 5 million, which was purchased 10 years ago, out of which 1 million is for the land. Expected life 50 years, that is unchanged. Entity policy is to make annual transfer from say revaluation surplus to retained earning. So show the excess. Okay, let's see the working first. So my cost is before 10 years. So I have land, building and total property. So it is given that before 10 years, this property cost was 5 million, out of which 1 million is for land, 4 million is for this. This we purchased before 10 years. So 10 years depreciation for 10 years. Land is non-depreciable asset, no depreciation on the same. Life of building is 50 years. So this divided by 50. We have to provide 10 years depreciation, so multiplied by 10, 0.8. So today the value is at the end of, what I would say, carrying amount at the end of 10th year is this 4.2. Now we are doing revaluation into this. So it is given this is revalued to 10 million. Revaluation 10 million, out of which 4 is for land and 6 is for the building. Total revaluation 10 million. So after that, revised carrying amount at the end of 10th year, this has become 5. This will become 9.2 and total property value is this one, 14.2. They are saying remaining life is unchanged. That means 10 years are already over. Now remaining life is 40 years. So depreciation 11th year. Again, land, no depreciation. This will be depreciated over a period of 40 years now. So this is my total depreciation for the period, and carrying value at the end of 11th year would be 5. 14 million, or it is revalued by 10 million. Fine, it's okay. Yeah. So 8.97, this is my revised value of the property. Now, what is the question here? So this is the presentation. Additional point, what they have said is they are doing annual transfer for the excess depreciation. So previously we used to provide annual depreciation of 4 million divided by 50 years, 0.08. Now we are providing annual depreciation of, it has increased to, I'm sorry, there is, okay, sorry, I did one mistake here. The revalued amount is 6 million itself. Property costing 5 million, revalued to 10 million. So this is becoming 4 million. So revaluation of 3. This is becoming 4 million. So there is a revaluation of 2.8. Now it is fine. Total revaluation of 5.8. I took that fair value as a revaluation. So no, this, so they are saying value is increasing to 10 million. So before that it was 4.2. From 4.2 it is becoming 10 million. So my additional depreciation is now 0.15. So how much extra depreciation I am providing? 0.07. Now for this, they are doing annual transfer. So how it will look into statement of financial position? Let's see. Depreciation. How much we are going to provide for 11th year? We find 0.15. Here the amounts are in thousand. So 150,000. We did revaluation 5.8. So that will be part of my other comprehensive income 5,800. Statement of financial position, we have land and building. See, it is 9.85. This is 9,850. Equity, if I talk about revaluation surplus, so there is total revaluation surplus of 5.8, out of which I am doing annual transfer of 0.07 to retained earning. So my revaluation surplus will be this 5.73. See, like this, 5,800 minus transfer to retained earning. This is carry forward. So this is annual transfer which is done. Is this okay? So either we can do annual transfer or we can keep. The previous question was like revaluation surplus there is no annual transfer. So we kept that 344 as it is. This question we are doing annual transfer. So to the extent of additional depreciation, this is adjusted and this balance shows 5730. And final point into property, plant and equipment is derecognition of the asset. So basically derecognition happens on disposal, that is sale of asset, or where no future economic benefits are expected. That means, say, when asset's useful life is over, that means now we are not expecting any benefit out of it. So at that point of time, asset is derecognized. So as we discussed, what we do at the time of derecognition. So we see compare the carrying value. So for example, if I'm selling the asset before the end of useful life, so I have some value in my balance sheet. I will compare this value with my selling price. Differential amount is my profit or loss on sale of asset. This will be recorded into statement of profit or loss immediately. Another option, say no future economic benefits are expected. That means my useful life of the asset is over. That means into my balance sheet asset has a zero value. Let's say if I'm able to generate some scrap value for the sale. So value 0, any scrap value I'm getting from disposal of this asset, that is my profit, will be recorded into statement of profit or loss. So whether we have applied cost model for property, plant and equipment or revaluation model, derecognition accounting treatment is same. Compare the carrying value with the disposal proceeds. Differential amount is my gain or loss. One more additional step that we have to do in case of revaluation model is at the time of derecognition, we have to see if any balance of revaluation surplus is there, then complete balance will be transferred to retained earning in one go. That is revaluation surplus debit to retained earning credit. That is what we have to account for. All right, so that is, we are done with all the concepts of property, plant and equipment. I have given some few practice questions also here. So basically what this material is, see, this is a mixture of the BPP study text, which is there for IFRS course, and another material which is Kaplan Publishing. BPP study material is little bit, I'm not finding it up to the mark for self studies. So what I did is I merged both the materials. I covered all the relevant points, something from BPP, 95% text is same. Maybe one point is given some in a different manner into Kaplan or into BPP. So I merged them all. I took all the practical questions from the Kaplan textbook as well as from the BPP textbook. So examples which we are showing here, this is my Kaplan textbook, which is now previously for IFRS, Kaplan also used to publish the study text, but now they are not doing. Now, right now only BPP is there, but Kaplan is publishing books for the ACCA syllabus. So ACCA final level, that is strategic business reporting syllabus is 100% same what we have in diploma IFRS, same subject, no change. So these are the questions out of this, and at last I kept this questions from the BPP for your additional practice. Otherwise from the text part, this is the maximum part which you can refer, no need to refer any other material, right? So this includes everything, Kaplan, BPP, all the explanations about the concept, everything. I'll share this on email with Mike, and Mike will forward this details to you. So I hope I'm clear on this part. And this is for property, plant and equipment. We are done for the day. Any questions on property, plant and equipment? And the question is, you guys comfortable with my approach of teaching? Any suggestions on that part? You guys are most welcome. So we can do necessary changes if needed from the upcoming class. Yes, please. Yes, guys, I'm done for the day. Now, any from your suggestions, comments?
Okay. Well, many thanks for this first lesson. I appreciate. And I'm good with your approach. Your approach is great. I learned many things about reevaluation, and I will do it to practice more when you share the material. I appreciate.
I will email this today itself right now, just after this lecture. And Mike also will share with you guys as soon as possible on the email. Yeah.
Okay.
I'm grateful too for the lesson. It was very, very good. I learned many new things. Honestly, many of that things you were sharing I didn't I have never used it before.
Okay.
And what I will do for now, my next step is to practice and to review the whole lesson so that I can be sure and produce new doubts for the next lesson.
Sure. Thank you. Thank you so much. Yeah.
Okay, thank you. For my side, I think that the explanation was very good. The approach is true. So what I will do now is to practice once we set the material. So
No problem.
then I've learned the new things about the revaluation. So we need to practice it.
All right.
So
Okay. Thank you
I
so
think
much,
that
guys. So, basic objective is just to confirm that you guys are comfortable the way I'm teaching. That is what my concern is. So we are good on this page, right? Yeah.
no, yeah, yes, about the way of teaching, I think that it's good. So,
Okay.
but we are come from Mozambique. Our native language is Portuguese, but we understand it very well. All the
Yeah.
words, all the explanation. Mm.
Yes, you are
No
speaking.
problem. Yeah.
It's helping.
Sorry?
I was saying that as the teacher is speaking slowly, it is helping